We are going to start subject of costing. In costing, there is one interesting chapter which is marginal costing. Which will be our first chapter for learning. Write down heading marginal costing. We are understanding first some basic points. First is the selling price. So let us take one business and understand each and every point. Suppose we are in a business of Pani Puri. It is estimated that we will be selling 10,000 dishes of Pani Puri per annum. This is what is our estimate. What we sell, what is our selling price per dish or per unit is rupees 10. Now we are going to sell dishes of Pani Puri. Try to understand, we are going to sell 10,000 dishes at the rate of rupees 10. So it will be 1 lakh rupees. We are going to incur some cost. First cost, variable cost. The cost which is dependent upon this number of dishes. If number of dishes will be manufactured more, we will be having more cost. If number of dishes will be manufactured less, we will be having less cost. A cost which is dependent upon output is nothing but variable cost. If it increases, output increases, variable cost increases, output decreases, variable cost decreases. What will be variable cost in our business? In our business, variable cost will be potatoes, right? If we want to manufacture more dishes, we'll have to purchase more potatoes. Pani, potato. Can any other student help me? Variable cost. Chana? Basically raw materials. Raw materials will be my variable cost. No other cost will be variable cost except raw material as far as my business is concerned. So I estimate that per annum this raw material cost is going to be 40,000 rupees. This is per annum. This is what is my estimate. At what level of activity? At 10,000 units production. This is dishes. 10,000 dishes of production, my variable cost is going to be 40,000 per annum. So my variable cost per unit is rupees 4. How 4? 40,000 rupees divided by, it is for 10,000 units or dishes. It is rupees. This is variable cost per unit. Let us try to understand some fixed cost. So we are not having a shop of Pani Puri. We are having a lorry of Pani Puri. So the fixed cost will be lorry, which is 20,000. Tape recorder, other fixed assets which are installed in my lorry, and depreciation of which is nothing but 10,000. And this costs are also per annum. So we might have taken lorry on rent, and the rent per annum is 20,000 rupees. What is the total fixed cost is? 30,000 rupees. Sir, what is fixed cost? this remains the same irrespective of your production. So this fixed cost is not dependent on this 10,000 units. Whether you sell 5,000 units, whether you manufacture and sell 5 units, whether you manufacture and sell nothing, this is going to happen. So this is known as fixed cost, and fixed cost is 30,000. Now please try to understand. I am trying to draw a marginal costing profitability statement which starts with the sales. At a level of 10,000 units, what will be my sales? Rupees 1 lakh minus variable cost. What is total variable cost? 40,000 rupees. Sales minus variable cost is termed as a contribution. Why contribution? Because sir, fixed cost is yet to be deducted. So we cannot term it as profit. Profit is the sales minus all cost is profit. So we term it as contribution. 60,000 minus fixed cost, in our case 30,000, and so my profit, this is actually operating profit, EBIT, is 30,000. This profitability statement whereby we find out contribution is known as marginal costing profitability statement. We are also learning one more point, which is contribution per unit. Next is contribution per unit. What was contribution in our case? Total contribution is 60,000. Total contribution is 60,000 divided by number of units over this 10,000 dishes. What will be contribution per unit is 6 rupees per dish or per unit. We can also find out contribution per unit by a simple formula: selling price per unit minus variable cost per unit will be is equal to contribution per. Selling price in our case is 10 rupees. Variable cost is 4 rupees. Answer will be 6 rupees per. Now this might seem easy up till this point of time. I am trying to explain you nature of variable cost and fixed cost with an example. Same example we are taking into consideration. Try to understand. I am writing, if we work at a level of 10,000 units that we have taken into consideration. If we work at a level of 20,000 units, and if we work at a level of 5,000 units, I am trying to do profitability statement under each and every point. If I sell and manufacture 10,000 Pani Puri dishes, if I manufacture and sell 20,000 Pani Puri dishes, and if I manufacture and sell 5,000 Pani Puri dishes. Let us start with sales. We know selling price per unit is 10 rupees. So total sales will be 1 lakh minus variable cost. What is the total variable cost at 10,000 units? It is 40,000. What is variable cost per unit? 4 rupees. Remaining will be my contribution. What is contribution per unit? 6 rupees. And what will be total contribution is 60,000. Minus fixed cost. What is fixed cost in our case? Fixed cost is 30,000 rupees. It is 30,000 rupees. What will be fixed cost per unit? 3 rupees. How we can find out? 30,000 divided by 10,000 units will be 3 rupees. And my profit will be 30,000. If I am manufacturing 10,000 pani puri and selling 10,000 pani puri, my profit will be 30,000 rupees. And profit per unit will be 3 rupees. I am filling up the point of 20,000 units. If I sell 20,000 pani puri units in current year, my selling price is going to remain 10 rupees. So sales is dependent upon production and sales. So 20,000 into 10 will be 2 lakhs rupees. See, total sales will increase, but selling price per unit, unless and until it is given, it will not increase. Variable cost will remain 40,000 rupees? No. Why it will not remain 40,000 rupees? Concentrate. 40,000 rupees variable cost we have decided for 10,000 units. So if you want to manufacture 20,000 units, your variable cost will be double. So variable cost will be 80,000 rupees because you want to manufacture double units, that is 20,000 units. I am finding out per unit 80,000 divided by 20,000. It is 4 rupees. This is 80,000 rupees. What is contribution per unit? 6 rupees. 6 rupees, and this will be 1,20,000. What will be fixed cost? What will be rent of the lorry if you are selling 20,000 units? It will still remain 20,000. What will be rent of tape recorder, utensils and other things? It will remain 10,000. It will not change. They are not dependent upon number of units. So my fixed cost remains same, which is 30,000. And my profit will be 90,000. But I want to find out a fixed cost per unit. Sir, it will remain 3. No, it will not remain 3. Fixed cost per unit will be 30,000 divided by 20,000, which is 1.5. And profit per unit is 4.5. If I am manufacturing and selling 5,000 units, my selling price per unit still remains 10 rupees. I am not changing my selling price. My total cost will be 50,000. But now try to understand, my variable cost will not remain 40,000. Why it will not remain 40,000? Because now I need to manufacture only 5,000 pani puri dishes. I will require less potatoes, less water, less chana, and so I will require exactly half. To manufacture 10,000 units, the cost was 40,000. To manufacture 5,000 units, cost will be 20,000. And 20,000 divided by 5,000 is 4 rupees. Let me change the color. It is 4 rupees and 20,000 rupees. My contribution will be 6 rupees per unit, and this will be 30,000. My fixed cost remains the same. It will remain 30,000. What will be fixed cost per unit will change. This is 5,000, 30,000, so it will be 6 rupees. my profit will be 0, profit per unit will be also 0. See why I did this? Because I want to explain you one basic fundamental principle. At whatever level of activity, my variable cost per unit is remaining same. So I am talking about variable cost per unit remains same. But total variable cost total is not remaining same. See this, 40,000, 80,000, 20,000. It increases as production and sales increases, and it decreases as production and sales decreases. So total does not remain same. Fixed cost. See the total fixed cost in all three cases, 30,000, 30,000, 30,000. So total fixed cost is remaining same. But fixed cost per unit, 3, 1.5, 6. Fixed cost per unit is not the same. See, anything which is remaining same is termed as fixed. Anything which is changing is termed as variable. So the name of a fixed cost and variable cost is given from total perspective. So, sir, variable cost remains a fix. Yes, variable cost per unit is always fixed. If you don't change the prices of your raw material, your variable cost per unit remains same. Sir, then it should not be called as fixed cost. No, the name is given from total perspective. Variable cost per unit is same, so it should be fixed, but the name is given from total. Because variable cost does not remain same, it is termed as variable. Fixed cost in total remains same, it is termed as fixed cost. Also, you may note down contribution per unit. I'm not talking about total contribution. Contribution per unit is remaining same. This is idea of variable cost, fixed cost, or contribution. We are going to a new idea, which is PV ratio. It is not PE ratio. In finance, PE ratio means MPS divided by EPS. PV ratio is also termed as a contribution margin ratio. See what is contribution margin ratio. PV ratio is equal to contribution divided by sales multiplied by 100. Multiplied by 100 means I'll be getting answer in percentage terms. Sir, if this ratio is 60%, what does this mean? Try to concentrate what does this mean. If my sales is rupees 100, my contribution is rupees 60 and my variable cost is rupees 40. If my sales is 100, my contribution is 60 and my variable cost is rupees 40. So for every 100 rupees sold, I earn a profit. No, contribution of rupees 60. This is what does contribution margin ratio means. Net profit ratio means, suppose if net profit is 20%, what does it mean? If my sales is 100, my net profit is 20. Here, what does it mean? If sales is 100, my contribution is 60. It is contribution margin ratio. It shows how much is your contribution in relation to your sales, because denominator is sales. Let us find out in our answer contribution margin ratio. What is total contribution? Sir, should I take it from 10,000 units, 20,000 units or 5,000 units? It does not make any difference. Whatever is your forecast, your contribution margin ratio is going to remain same. Let me prove it. Let me take from first 10,000 units. Contribution is 60,000. Sales is 1 lakh. Multiplied by 100 will be 60%. Had I taken from second one, 1,20,000 divided by 2 lakhs multiplied by 100. 1,20,000 divided by 2 lakhs multiplied by 100. This will also come 60,000. So you can take it from any level of activity. What does this mean? My variable cost is 40% of sales. Sales is 100%, then variable cost will be 40% and 60% will be contribution. PV ratio will become a base for solving marginal costing questions. So let us try out each and every method by which we can find out PV ratio. PV ratio can also be found out by contribution per unit divided by selling price per unit multiplied by 100. Let me check in this question whether it is coming correct or not. What is contribution per unit? See, at 10,000, 20,000 or 5,000 level, the contribution per unit is remaining same, which is 6. Selling price per unit is rupees 10. So it is also remaining same. I can take it. Contribution 6, selling price per unit 10 multiplied by 100 is 60%. So even this is the formula for PV ratio. Third one. See what I am finding. Change in contribution. Now you have done financial management leverage. It is not percentage change in contribution. There is difference between percentage change in contribution and change in contribution. Divided by change in sales multiplied by 100. I can also find out contribution per unit. Now, let me take this two, 10,000 units and 20,000 units. I am comparing this two. You can compare any two. My contribution was 60,000. Now my contribution is becoming 1,20,000. So what is the change in contribution is 1,20,000 minus 60,000. Change in contribution in terms of rupees, not in terms of percentage. 60,000 and 120,000. So contribution has increased by 60,000. Sales have increased how much? Sales has increased from 1 lakh to 2 lakhs. So what is change in sales? 1 lakh. 2 lakh minus 1 lakh is 1 lakh. Multiplied by 100, I will be getting still answer of 60%. Let me try out this. Let me compare 20,000 and 5,000. What is change in contribution? What is change in contribution between 20,000 and 5,000? It is decreased by 90,000 rupees. 1,20,000 and 30,000. So it has decreased by 90,000 rupees. PV ratio. change in contribution is minus 90,000. You can write down minus 90,000. No problem. What is change in sales? From 2 lakh, it is becoming 50,000. So change in sales is 1,50,000 multiplied by 100. So 9 divided by 15 multiplied by 100 is nothing but 60%. Sir, how it is important? If we are knowing change in contribution, we will be knowing contribution. Then it is easy to use this formula. Say in some question it will be given only change in contribution. Then you will have to understand by change in contribution and change in sales, you can find out a PV ratio. One more, last. PV ratio can also be found out by this. Change in profit divided by change in sales multiplied by 100. Say I am comparing this to this. Let me compare 10,000 and 20,000. What is change in profit? It was first 30,000. Now it has become 90,000. It has increased by 10,000. So change in profit, it has increased by 10,000. Change in sales, it has increased by 1 lakh rupees. No, it has increased by 60,000. Huh? 30,000 and 90,000. This is profit. It has increased by 60,000. What is change in sales? 1 lakh rupees. At 10,000 units, it was 1 lakh. At 20,000 units, it is 2 lakh. So change in sales is 1 lakh rupees. Multiplied by 100 is 60%. See, change in contribution and change in profit in terms of rupees. I am not talking about percentage. Don't confuse it with leverage. Change in percentage and change in rupees is something different. If you will see difference between the 60,000 and 1,20,000, the 60,000 and 1,20,000, 60, 1,20,000. What is the difference? 60. 30 and 90. What is the difference? 60. 1,20,000, 30. What is the difference? Minus 90. 90, 0. What is the difference? Minus 90. So difference change in contribution is equal to change in profit. So instead of change in contribution, I am writing down change in profit. Let me summarize all the formulas for PV ratio. And this will be very much important because each and every questions of marginal costing will deal with PV ratio. What is PV ratio? It shows how much percentage is your contribution in comparison to your sales. What is number one formula? Total contribution divided by sales multiplied by 100. Second one, contribution per unit divided by selling price per unit multiplied by 100. Which is third one? Change in contribution, not percentage change in contribution. Change in contribution as far as rupees is concerned, divided by change in sales multiplied by 100. And which is the fourth one? It is change in profit. And this is excellent because change in contribution in terms of rupees will be equal to change in profit in terms of rupees because fixed cost remains same. If fixed cost changes, this will not happen. Change in profit divided by change in sales multiplied by 4 formulas and very important formulas for marginal costing. And so this chart help out to understand variable cost, nature of variable cost, it remain totally it is variable, fixed cost totally it is fixed, but per unit variable cost remains same, per unit fixed cost does not remain same. This chart also helped us out to understand one concept, which is PV ratio, which shows how much is your contribution in percentage terms in comparison to your sales. Let us go to next point, which is segregation between fixed cost and variable cost. Now, practically, this is a puzzle. Let me give you, for a same unit, if the output is 10,000 units and if the output is 20,000 units, total cost is 1,20,000 and here the total cost is 1,80,000. I want you to segregate between variable and fixed. Total cost is 1,20,000. So portion will be variable, portion will be fixed. Here the total cost is 1,80,000. Total will there will be variable, there will be fixed. Total will be 1,80,000. You can take 5 minutes and try out. You need to tell me it is for the same unit. And let me just give you a hint. Fixed cost in both the case will remain same because fixed cost remains same irrespective of your total output. Let me solve it. Whenever there is a change in total cost, first, what is the change in total cost? 1,80,000 minus 1,20,000 is 60,000. Whenever there is a change in total cost, the change is always because of variable cost. Whenever there is a change in total cost, the change is always because of variable cost. Let me prove it. What is total cost over here? 40 plus 30. That is 70. What is total cost over here? 80 and 30. So it is 1,10,000. What is the difference? 40,000. Believe me, there is a difference of 40,000 because of variable cost. See, fixed cost is remaining same. What is change in variable cost is 40,000. So change in total cost is nothing but change in variable cost. So this is change in total cost will be equal to change in variable cost because total cost changes. I'm not talking about total cost. I'm talking about change in total cost. Change in total cost is nothing but change in variable cost divided by change in units. What is the change in units? 10,000 to 20,000. That is 10,000 units. Will give me answer of total cost per unit. No, it will give me answer of variable cost per unit because my numerator is a change in variable cost. This is a change in output, number of units. Change in variable cost divided by change in number of units will give me nothing but variable cost per unit. So if variable cost per unit, and we have understood variable cost per unit remains same, So variable cost in this case will be 10,000 into 6 will be 60,000. Remaining will be fixed cost. So if total is 1,20,000, variable is 60, fixed cost will be 60,000. Again over here, 20,000 into 6, variable cost will be 1,20,000. Total cost is 1,80,000, variable cost is 1,20,000. So fixed cost is 60,000. Proof that our concept is correct. Fixed cost is remaining same. How to segregate between fixed cost and variable cost? Very easy. Change in total cost divided by change in output will be equal to variable cost per unit. Sir, we need to mug it up? Yes, but do it logically. Why this happens? Because change in total cost is nothing but change in variable cost. Total cost does not changes because of fixed cost, because fixed cost in both the criteria is going to remain same. Let us try out one more question. Output 100 units, 120 units. Total cost it is these are diamonds. So total cost is 700 crores. You can take it 700. Huh? It is 780. Instead of crores, you can take it rupees. It does not matter. You need to tell me what is variable cost and what is fixed cost now. Again, you can take 2 minutes. So how I'll be find out? Change in total cost is 80 rupees. Change in units is 20. 4 rupees per unit. Actually, it is 4 crore rupees per unit is nothing but variable cost. So what will be total variable cost? 100 into 4 will be 400 rupees. 120 into 4 will be 480 rupees. What will be fixed cost then? 700 minus 400, 300. 780 minus 480 will be 300. Fixed cost is remaining same. This is nothing but segregation between fixed cost and variable cost. All right. Let us go to next concept, and that is the main core concept. That is, this type of questions are even asked in examination. No one will ask you in examination what is contribution per unit. We are going to concept of break even point. In short, it is valid short form. In short, it is also termed as BEP, break even point. Try to concentrate in the same situation of Pani Puri. If someone tells me at what level of activity you will be earning no profit, no loss. At what level of activity? Practically in marginal costing means a level of activity basically means the sales. Now sales can be in units or can be in rupees, but they are asking me this. At what level of activity there will be zero profit, there will be no profit, no loss. Practically means there will be zero profit. How I will find out in my example, in Pani Puri example? We have already got the answer. See, here there is zero profit, right? So what is our break-even point in our example? Pani Puri example, break-even point is 5,000 units. Break-even point in units is 5,000 units. And break-even point in rupee. What is break-even point? What is the sales in rupees at 5,000 units is 50,000 rupees. So break-even point in rupees will be 50,000 rupees. What does this mean? If I exactly sell 5,000 units, or if my total sales is 50,000 rupees, I will be earning zero profit. So 5,000 units or 5 lakhs rupees, sorry, 50,000 rupees is my break-even point. Break-even. At this point, I will be earning zero profit. Now, as an academician, why we want to have a sale of 5,000 units only? We are not earning any profit at 5,000 units. Why we need to have a sales of 50,000 rupees? Then why we are finding out this point? Try to concentrate. This is the sales line. And this is break-even point. 5,000 units or 50,000 rupees. Where this helps me? If my sales per annum will be less than 5,000 rupees, if it will be less than 5,000 units or 50,000 rupees, I will be incurring losses. If I will be earning or if I will be selling more than 5,000 units or 50,000 rupees, I will be having profit. So it is important to find out. Try to understand. I am running this Pani Puri business and my total sales is 7,000 units per annum. What does this mean? I will be earning profits. My total sales is 3,000 units per annum. At the end of the year, I know that I have not crossed my break even, so I will not be earning any profits. So below 5,000 units, I will be earning losses. Over 5,000 units, if I sell, I will be earning profits. Below 5,000 units, I will be incurring losses. And so we find out this. So understand, if someone is starting the business, I ask them, what is your break-even point? They say me 1 crore rupees. Then I tell them that it is not feasible in the small city to have a sales of 1 crore rupees. So what I am telling, that this business will be incurring losses at least in first year if you start the business, because I feel that you will not be able to attain your break-even. This is how the concept of break-even is used. This point is used to decide or to forecast whether you will be earning profit or whether you will be incurring losses. Below break even, you are incurring losses. Above break even, you will be earning profits. This is concept of break even point, but we have not yet understood how to find out. We got it. We were solving some of the question and we got a profit of 0 rupees. But this is not how every time we will be finding out break-even point. Try to concentrate. I am first talking in units, right? I am first talking in units. Break-even point in units. Can I say at break-even point, my profit is 0? How to find out profit? It is the sales minus variable cost minus fixed cost is nothing but profit. We are not talking about contribution. I want profit 0. What will be sales? Can I say sales in units? U is units multiplied by selling price per unit. What is variable cost? This is sales. What will be variable cost? Minus sales in units, number of units sold, multiplied by variable cost per unit. This is nothing but variable cost. Number of units sold multiplied by variable cost per unit will be total variable cost, minus fixed cost should be equal to 0. If it is 0, sales units, this is the unit sales at which my profit will be 0. Means that the sales unit is nothing but my break-even point. Fixed cost, I will be taking it on right side. Here, sales per unit or sales in units, not per unit, sales in units, I can take it as common. Sales in units, which is my break-even point. At this level of sales, I will be earning 0 profit. What will be remaining? If I take sales in unit as common, what will be remaining is a selling price per unit minus variable cost per unit. And this fixed cost, I am taking it on right hand side, will be is equal to fixed cost. It is negative going right hand side, that is right hand side of the equation, it will become positive, will be fixed cost. Now we have absolutely understood the sales in units is nothing but break-even point. Break-even point in units, level of sales at which there is 0 profit. There is a sales unit at which the profit is 0. So break-even point in units will be is equal to fixed cost. And as this is multiplication over here, it will become division over here. Selling price per unit minus variable cost per unit. So, break-even point in units will be is equal to fixed cost divided by contribution per unit. What is the selling price per unit minus variable cost per unit will be is equal to contribution per unit. So break even point in units is a fixed cost divided by contribution per unit. Let us also check in our question whether the answer is correct or not. Break even point in units, what was our fixed cost in our original question? Fixed cost was 30,000 and contribution per unit was 6 rupees. 30,000 divided by 6 rupees. So 30,000 rupees divided by 6 will be 5,000, and this answer will be in units because it is break even point in units. Was our break even point 5,000? Yes, we directly got it because at 5,000 units we know that the profit is 0. So break even point, we were knowing it, the formula will be correct. Try to understand in other terms also. Let me write down what was our fixed cost. Our fixed cost was 30,000 rupees. Try to concentrate in a logical terms. If I sell one dish of pani puri, what is my contribution? Will be rupees 6. This I have found out. What is this contribution per unit? If I am selling one dish of pani puri, my contribution per unit is 6. What does it mean? By selling one dish, I earn rupees 6, but still fixed cost is to be deducted. Fixed cost is not yet covered because this is contribution and not profit. So by selling one dish, I earn a contribution of 6 rupees. Now, how much rupees I want to cover? Because I don't want to earn any profit, I would like to cover only 30,000 rupees. I don't want to cover anything more. So 30,000 rupees I want to cover. I want to cover rupees 30,000. Why? If I cover more, I will be earning profits. I want the level of sales at which there is no profit, no loss. So I just want to cover fixed cost from my sales. How many dishes I should be selling? What is the answer? 30,000 divided by 6 rupees. What is 30,000? Fixed cost. What is contribution per, what is 6? Contribution per unit. Try to watch, see the formula and understand it. Fixed cost 30,000, I want to cover it. One dish covers a 6 rupees denominator. How many dishes should be sold so that I cover my exactly fixed cost? Variable cost is already covered in contribution per unit. What is contribution per unit? Sales minus variable cost. So variable cost is covered, but fixed cost is yet to be covered. To cover 30,000 rupees fixed cost and per dish is covering 6 rupees, I will have to sell 5,000 dishes to cover my fixed cost on exactly 0 rupees profit. Summarizing the formula, it is break even point in units, fixed cost divided by contribution per unit. Do you all agree with the statement? At break even point, my fixed cost will be is equal to total contribution. At break even point, my fixed cost will be is equal to total contribution. Do you agree or do you not agree? At break even point, my fixed cost will be is equal to total contribution. Then only profit will be 0. Contribution minus fixed cost is nothing but profit. Profit answer is 0 at break even point. So at break even point, my total contribution will be is equal to fixed cost. Let me give you a logical idea last time about break even point. Try to concentrate. This is my sales line in units. What is my fixed cost? Rupees 30,000. If I sell to say 1,000 dishes of pani puri, 1,000 dishes, how much contribution I would be earning? I would be earning contribution of rupees 6,000. If I sell 3,000 dishes of pani puri, I will be earning 18,000 rupees as contribution. If I sell 5,000 dishes of pani puri, I would be earning 30,000 rupees as contribution. And at break even point, my fixed cost and contribution should be same. So this is a level of activity. What is the level of activity? 5,000 dishes is nothing but break even point. Try to concentrate. Now my contribution will increase. If I sell 10,000 dishes, my contribution will be 60,000 rupees. At 10,000 dishes, What is my profit? Total contribution will be 60,000 minus fixed cost is 30,000. So my profit is also 30,000. See, so the name contribution, try to concentrate. What is contribution at this level? 60,000 rupees. Contribution contributes first towards a fixed cost. So what contribution will be doing? It will be trying to cover fixed cost first. Once the fixed cost is covered, it will contribute towards profit. See the name. Contribution towards a fixed cost. So first it will start covering fixed cost. What will your contribution do? Contribution will start covering your fixed cost. And then what it will do? It will contribute towards the profit once fixed cost is covered. So at 10,000 dishes, what is your contribution? 60,000. First it will cover fixed cost. 30,000 is your fixed cost. So remaining contribution of 30,000 is nothing but your profit. Try to understand at 20,000 level even. Suppose your dishes are 20,000. At 20,000 dishes, what will be your contribution? 20,000 into 6. 1,20,000. 1,20,000 minus fixed cost 30,000, and what is your profit is 90,000. See again this chart. What is my contribution? 1,20,000. First this contribution will cover my fixed cost. What is my fixed cost? 30,000. Remaining will be my profit, which will be 90,000. 30 plus 90 is equal to 120. So I am trying to logically explain you the name. Contribution is a short form. What is contribution? Is contribution towards fixed cost and then towards profit. This is the full name, but we cannot write down this full name every time. So we write down just contribution. It first contributes towards fixed cost and then it contributes towards profit. We are out of our line, but break-even point in units will be is equal to fixed cost divided by contribution per. What will be break-even point in rupees? As simple as this. Break-even point in units. In our example, 5,000 dishes multiplied by selling price per unit. Multiplied by 10. Our dish, Pani Puri dish was having selling price of 10 rupees. 5,000 into 10 rupees is 50,000 rupees. So break-even point in rupees is very simple. Break-even point in units multiplied by selling price per unit. What is break-even point in units? It is the fixed cost divided by contribution per unit multiplied by selling price per unit will be nothing but break-even point in rupees. I am taking this on this side. It is a fixed cost multiplied by selling price per unit upon contribution per unit. Contribution per unit, I am just taking it on right hand side. Can I write down? It is fixed cost. If I want to convert this multiplication into division, what does mathematics says? If you want to convert multiplication into division, you will have to do reciprocal. Means contribution per unit will come in numerator now. Contribution per unit divided by selling price per unit. What is this? Contribution per unit divided by selling price per unit multiplied by 100. We don't consider multiplied by 100. What is contribution per unit divided by selling price per unit? PV ratio. Contribution per unit divided by selling price per unit. Is it PV ratio? Yes. So instead of contribution per unit divided by selling price per unit, I am writing fixed cost divided by PV ratio. And now I am writing it properly. It is break even point in rupees is fixed cost divided by PV ratio. So I can use this formula. I can use this formula to find out break even point in rupees. This is break even point in rupees, the two formulas. By both the formula, I want to verify whether my answer will be correct or not. In my question, let me write it down over here. What was selling price per dish? Was a 10. Variable cost per dish was a 4. And fixed cost was rupees 30,000. PV ratio was 60%. This we know. Let me find out by this formula. What is our answer? Break even point in rupees. In our example, break even point in rupees was 50,000 rupees. Rupees 50,000. That we know, right? In one of our answer, the profit was coming 0 and break even point was 50,000 rupees. Let us verify by this formula we are getting 50,000 or not. What is break even point in units? That we have found out 5,000 units. We have done over here, and numbers of times we have done. This is also the same. So it is 5,000 units. What is the selling price per dish? 10 rupees 50,000. So the formula seems to be correct. Let us try out over by this formula also. Fixed cost divided by PV ratio. What is fixed cost? 30,000 divided by PV ratio divided by 0.60. You can even do divided by 60%. It is 30,000 divided by 0.60. What is the answer? Rupees 50,000. So I can find out break even point in units by fixed cost upon contribution per unit and break even point in rupees by fixed cost upon PV ratio. Yes, for rupees I can also find out break even point in units multiplied by selling price per unit. So alternate formula is break even point in units multiplied by selling price per unit will also give me break even point in. But try to always compare this. Whenever it is break even point in units, what is divided is contribution per unit, and whenever it is break even point in rupees, what is divided is a PV ratio. Sir, if we are having break even point in units, isn't this a easy formula? Yes, but sometimes all the figures will be given in rupees. You will not be able to find out anything in rupees. You will have to have knowledge of this formula to get the answer. I hope all the formulas are logically even clear to you. We have derived each and every formula and then written it. We are not just mugging up the formulas. We are even trying to understand the formula. This is a summary of break even point. What is break even point? It is unit sold or rupees sales at which there is no profit or no loss. Why we need to find out break even point? Because below that level of activity you will be incurring losses. Above that level of activity you will be having gains, that is profits. Let us continue with next concept. What is next concept is sales in units or in rupees. See, first our idea was to get a sales at which there is no profit, no loss. But now I want some profit. For getting desired profit. So let me write down the same financials for our Pani Puri business. Selling price at 10 rupees per dish. Variable cost 4 rupees per dish. Contribution is 6 rupees per dish. And fixed cost is rupees 30,000. Now if someone tells me find out the level of activity where there is no profit, no loss, they are asking me break even point. But see what they are asking. Find out level of sales or sales. Sales at which there will be profit of rupees 90,000. Find out the sales at which there will be a profit, not a contribution. There will be a profit of rupees 90,000. So I'm asking them whether you want sales in units or in rupees. They want in units. So they are telling me how many dishes of Pani Puri should they sell or should I sell to earn a profit of rupees 90,000. Now how it can be find out, try to understand. Whenever it is units, sales for a desired profit in units, I'm writing left hand side this, right? Sales for desired profit in terms of units will be is equal to contribution per unit. In denominator, I am writing contribution per unit. What is contribution per unit in this case? 6 rupees. I earn contribution rupees 6 per dish. What I want to cover, contribution covers something, right? We have learned this. Contribution first covers the fixed cost and then it covers the profit. So how much I want to cover? First I want to cover a fixed cost of 30,000. And then I want to cover 90,000 rupees profit. So I want a total contribution of 1,20,000, right? 90,000 profit and 30,000 fixed cost is a total contribution of 1,20,000. Total contribution 1,20,000. Total contribution minus fixed cost 30,000. Then my profit will be 90,000. So my desired contribution is 1,20,000. Contribution covers fixed cost and then profit. What is 30,000? Fixed cost. What is 90,000? Desired profit. I will be getting answer of sales in units at which my profit will be 90,000. Let me try it out. Fixed cost 30 plus 90 is 1,20,000. Divided by 6 rupees will be 20,000 units, that is dishes. At 20,000 units, my profit will be 90,000 rupees. Let me prove it. We have already proved it somewhere before, but let us prove it again. If my sales is 20,000 units, selling price is 10, so sales will be 2 lakhs rupees minus variable cost is rupees 4, so 20,000 into 4 is 80,000 rupees. So my contribution will be 1,20,000 rupees minus fixed cost will be 30,000 rupees. And so my profit is 90,000 rupees. So this is the answer. 20,000 units is a sales at which I will be earning a profit of 90,000 rupees. Once again, try to understand how we have found out. We wanted a contribution of 1,20,000. Why I want a contribution of 1,20,000? Then only my fixed cost is 30,000, so my profit will be 90,000. If I want a profit of 0, my fixed cost is going to remain 30,000, and so my contribution should be 30,000. So at break-even point, I wanted a contribution which is equal to fixed cost, which is 30,000 in this case. But if I want a profit of 90,000, now I will need total contribution of 1,20,000. How much a total contribution I want? 1,20,000. One dish gives me how much contribution? 6 rupees. So how much dishes will give me a total contribution of 1,20,000? That is 1,20,000 divided by 6. What is 1,20,000? It is fixed cost plus desired profit. And what is a 6 is contribution per unit. And so this gives me answer of desired profit. It is brother of break-even point. Break-even point, my desired profit is 0. And at a desired profit, my desired profit will be normally some positive answers. Now, if someone tells me, find out the sales in rupees at which there will be profit of rupees 90,000. Now we can easily do this, right? Our profit at 90,000 was at 20,000 units multiplied by 10. That is this. At 2 lakhs rupees sales, my profit will be 90,000. But how to find it out? Very easy. Sales for desired profit in units. Multiplied by selling price per unit will be is equal to sales for desired profit in rupees. Let me find out in our case. Sales at desired profit in units was 20,000 units. What is selling price per unit? 10, which will be rupees 2 lakhs. What is the 2 lakhs rupees? If my sales is rupees 2 lakhs, my profit will be as per my desire, that is rupees 90,000. That we have already proved over here. If the sales is 2 lakhs, my profit is 90,000. But this desired profit sales in rupees, sales for desired profit in rupees can be found out by different formula also. Fixed cost plus desired profit upon PV ratio. We are not deriving the formula, but it can be same way derived as we have derived this. It will be same. Believe me, break-even point is also desired profit question only. Break-even point, my desired profit is 0. It will be just added in numerator. Whatever is my desired profit will be just added in numerator. So fixed cost plus desired profit upon PV ratio. Let us find it out in our case. Fixed cost is 30,000. My desired profit is 90,000. And in our Pani Puri case, PV ratio is 60%. 1,20,000 divided by 0.60 will be rupees. Once again, try to understand the concept. At 2 lakhs rupees sales, my profit will be 90,000. Now, why you want a profit of 90,000? You might want to do this business only if you earn a profit of 90,000. So you want to find out how much sales I should be doing so that my profit is 90,000. And we have also understood the logic behind it. So what we have done, break-even point. Then we also understood the concept of desired profit. In break-even point, my desired profit will be 0. Now let us understand a new concept, which is margin of safety. Is also termed as MOS. I will be taking my base example same so that it becomes easy for understanding. My selling price per dish is rupees 10. Variable cost per dish is rupees 4. Contribution per dish is rupees 6. PV ratio is 60 or 60%, and my fixed cost is rupees 30,000. I also know my break-even point, right? Break-even point in units is 5,000 units. Sir, it is not 20,000. No, 20,000 is desired profit. Huh? And break even point in rupees, also I am knowing this, it is rupees 50,000. 5,000 into 10. Also I have found out n numbers of time. Now try to concentrate. My actual sales. My actual sales is 5,000 units. No, actual sales is not 5,000 units. This is just a figure which I have found out that at 5,000 units there will be no profit, no loss. Then what is my actual sales? Is 7,000 dishes. So I have found out my break-even point. My break-even point was 5,000 units. I started my business and in 1 year I actually sold 7,000 units. Can you tell me, we will be having profits or we will be having losses? How much profit is not important or how much loss is not important? We'll be having profit or loss? Profit? That's correct. We will be having profit. What is the reason? Because we are selling more than break-even point. We will be having profits and will not be incurring losses. So my actual sales is 7,000 dishes. Try to understand. Once again, I am drawing number line for the sales. This is 0. This is infinite. This is a sales in units. What was my break-even point? 5,000 units. What I am actually selling is 7,000 units. Then this is nothing but my margin of safety. See, below 5,000 units, I was going to incur losses. I have not sold 5,000 units. I have sold 7,000 units. Then 2,000 units is my margin for safety. If my sales decreases by more 1,000, I will not be happy, but I will not be incurring losses. If my sales decrease by 2,000 units, I will again not be happy, but I will not be incurring any profit, any losses. But if my sales go down beyond that 2000 unit mark, then I will start incurring losses. So my margin of safety will be 2000 units. Margin of safety is 2000 units. See, it is like this. This is the road. I am walking over here. There is a truck passing from here. What is the distance between me and truck is 2 centimeters. What is the loss? Accident. What is margin of safety? 2 centimeters. All right. Where I am right now, 7,000 units. When I will be having an accident, if I go below 5,000 units, that is my loss. So what is margin of safety is 2000 units. Between break-even point in units, actual sales. I am converting it into formula. Margin of safety in units will be is equal to actual sales in units minus break-even point in units. Actual sales minus break-even point is nothing but margin of safety. And this is very easy to understand, right? 7,000 units sold, 5,000 units below 5,000 we are going to have loss. So 2,000 is margin of safety. Margin of safety is also calculated sometimes in percentage. So margin of safety in percentage is margin of safety divided by sales multiplied by 100. And the sales is actual sales. So what is margin of safety? 2000 units upon actual sales is 7000 units multiplied by 100. Margin of safety in percentage will be 2 divided by 7 multiplied by 100. That is 28.57%. Sir, what does this mean? Percentage MOS. What does this mean is my sales right now is 7,000 units. If it decreases by 10%, that is by 700 units, I will be still having profits. If it decreases by 20%, I will be still having profits. If it decreases by 25%, I will be still having profits. If it decreases exactly 28.57%, I will be having break even. That is no profit, no loss. If it exactly decreases by 28.57%, I will be having no profit, no loss. Beyond that, if my sales decreases by 30%, I will start incurring losses. Let me find out. 7,000 minus 28.57%. It is 5,000 units. 5,000 is my break-even point. So if my sales decreases exactly by 28.57%, I will be incurring no profit, no loss. Beyond that percentage, more than 28.57%, I will start incurring losses. If my sales decreases by 20%, I will not be still incurring losses. This is margin of safety in percentage. I am doing on same page margin of safety in rupees on the same page with different color pen. My actual sales in rupees will be 7,000 into 10 because my one dish is selling at 10 rupees. It will be rupees 70,000. My number line is in rupees. What is my break even point in rupees? 50,000 rupees. What will be my actual sales in rupees? 70,000 rupees. What will be my margin of safety in rupees? 20,000 rupees. 70,000 minus 50,000, or you can even do 2,000 into 10. So margin of safety in rupees will be is equal to actual sales in rupees minus MOS in rupees. Everything will be converted into rupees. And my percentage answer will remain same. Margin of safety in percentage will be same thing. It will be, instead of 2,000 units, it will be 20,000 rupees, which is my margin of safety, upon total sales in rupees, which is 7 lakh, multiplied by 100. I will be getting same answer. So if you want to find out in percentage terms, it is margin of safety divided by actual sales into 100. If you take units in numerator, you take units in denominator. If you take rupees in numerator, you take rupees in denominator. Let me just summarize on a new page. MOS. In rupees, in units. MOS in rupees will be sales in rupees minus break-even point in rupees. MOS in units will be sales in units minus break-even point in units. And MOS in percentage is MOS either in units or in rupees divided by actual sales. If you have taken numerator rupees, numerator units, denominator units, multiplied by. So you are having margin of safety. Suppose this answer is 10%. If your sales goes down beyond this 10%, you will start incurring losses. Let us understand something interesting from margin of safety. Again, I am taking the same example which we have taken. Our break-even point is 5,000 units or 50,000 rupees. Our actual sales is 7,000 units or 70,000 rupees. Our selling price is 10, variable cost is 4, contribution per unit is 6, PV ratio is 60%, and fixed cost is 30,000. We have also understood our margin of safety. Margin of safety is 2,000 units or 20,000 rupees. Try to understand first point. What will be my answer if I do? This is my break-even point, right? Break-even point in units multiplied by contribution per unit. What will be my answer? Break even point in units multiplied by contribution per unit. It will be total contribution at break even point, which will be nothing but fixed cost. It is total contribution at break even point, and at break even point, total contribution is equal to fixed cost. Break even point in units multiplied by contribution per unit. What is break even point in units? 5,000 units multiplied by contribution is 6. This is 30,000 rupees, which is nothing but fixed cost. One more. Break even point in units multiplied by, break even point in rupees multiplied by PV ratio will be also fixed cost. It is just the game of rupees and contribution per unit, right? This is units, this is rupees. Whenever there is rupees, PV ratio will be in picture. Whenever there is units, it will be contribution per unit. Break even point in rupees is 50,000 multiplied by PV ratio is 60%. This is 30,000 rupees, which is my fixed cost. Say I'm just going here to here. Ultimately, you feel it is a different type of formula. What is break even point in units? It is fixed cost divided by contribution per unit, right? Contribution per unit going on left hand side. Break even point in units multiplied by contribution per unit is equal to fixed cost. This is what I have written over here. Same way, what is break even point in rupees? It is a fixed cost divided by PV ratio. PV ratio coming on left side is nothing but this formula, right? Break even point in rupees multiplied by PV ratio is nothing but fixed cost. So it is one and the same formula. It is break even point formula. It is nothing else. All right. Then can anyone answer me what will be this idea? Actual sales in units. Now understand, whenever there will be units, I will multiply, divide contribution per unit. Actual sales multiplied by contribution per unit. What will be the answer? Actual sales multiplied by contribution per unit will be nothing but total contribution. Actual sales multiplied by contribution per unit will be total contribution. You can find out 7,000 into 6. It is how much? 42,000. 42,000 minus 30,000. It will be 42,000 is total contribution. Let me find out actual sales. If sales is 70,000 rupees, variable cost will be 28,000. Total contribution will be 42,000 minus a fixed cost 30,000. Profit will be 12,000. So our actual profit is 12,000 because 70,000 rupees is actual sales. Total profit is 12,000. Total contribution is 40,000. Let me verify whether this is the correct answer or not. Actual sales is 7,000 units multiplied by 6 will be 42,000, which is nothing but total contribution. Actual sales multiplied by PV ratio This actual sales is in rupees. Are you getting an idea? When I take it in rupees, I take per rupee what is the contribution, which is nothing but PV ratio. Will be also total contribution. Actual sales is 70,000 rupees multiplied by 0.60 will be 42,000. Now I am trying to go to main idea. Try to concentrate. If I do this level multiplied by contribution or PV ratio, if it is in units, contribution per unit, if it is rupees, PV ratio, then I get fixed cost. See, what is this? Break even point. I told you, till the time break even point is achieved, your contribution is covering your fixed cost. Once the fixed cost is covered, it will be covering your profit. Try to concentrate. What now I am finding out? Margin of sales in units multiplied by contribution per unit. What will be answer? Neither it will be fixed cost, neither it will be total contribution. The answer directly I will be getting is profit. Let me find out in our case whether the answer is coming or not. Margin of safety in units. So 2000 units multiplied by 7 so contribution per unit is rupees 6. This will be 12,000 rupees. Why 12,000 rupees? Neither I am taking total sales, neither I am taking break even point. I am taking difference between total sales and break even point. Difference between total sales and break even point means your fixed cost is already covered. So contribution in margin of safety is nothing but profit. Try to understand. My contribution is covering my fixed cost and then it is covering my profit. So if someone tells me that how much this 2000 units are earning contribution, 2000 units are earning a additional contribution over and above fixed cost of rupees 12,000, which is nothing but my profit. It is earning 12,000 rupees contribution over and above my fixed cost. So fixed cost is already covered in that 5,000 units. Additional 2,000 units is covering my profit. So ultimately additional units multiplied by contribution per unit will be nothing but profit. And in similar manner, MOS in rupees multiplied by PV ratio will be also equal to profit. Let me verify whether my answer is correct or not. MOS in rupees is 20,000 rupees multiplied by PV ratio is 60, which is nothing but 12,000, which is nothing but my profit. And this will be helpful to us. Even this is helpful to us. This is covering fixed cost of 30,000 and this portion is covering an additional amount of 12,000. So 7,000 units is covering totally 30,000 plus 12,000, that is 42,000. 30,000 contribution will be covered in fixed cost and remaining 12,000 will be your profit. So if you just do MOS multiplied by contribution per unit or PV ratio, you get answer of profit. Let me just summarize it. MOS in units multiplied by contribution per unit is nothing but profit. See, visualize every time number line in the mind. Break even point into contribution per unit is nothing but fixed cost. MOS multiplied by contribution per unit is profit. And total sales multiplied by contribution per unit is nothing but total contribution. So MOS in units, let me also write down this. Break even point in units multiplied by contribution per unit will be your fixed cost. And total sales in units multiplied by contribution per unit will be fixed cost plus profit, and fixed cost plus profit is total contribution. Total sales is nothing but break even point plus margin of safety. This is nothing but break even point plus margin of safety. So multiplied by contribution per unit will be fixed cost plus profit. If it is in rupees, then MOS in rupees multiplied by PV ratio will be profit. Break even point in rupees, whenever it is rupees, you need to multiply PV ratio. Something which is units can be multiplied with contribution per unit. Something which is rupees should be multiplied with percentage, will be fixed cost. And actual sales in rupees multiplied by PV ratio is nothing but fixed cost plus profit, which is nothing but total contribution. Next concept that we are going to learn is shutdown point. Try to understand. For understanding this concept, you will have to understand concept of a fixed cost. What are fixed costs? They remain fixed irrespective of production. Suppose my fixed cost is rupees 1 lakh. Whether I produce 0 pani puri dishes, so whether I produce 10 pani puri dishes or whether I produce 1 lakh pani puri dishes, my fixed cost is going to remain rupees 1 lakh. If I am running a factory, what are my fixed cost? Rent is my basic fixed cost. Salary of permanent persons is also my fixed cost, because they are not dependent upon how much I will manufacture. It is irrelevant of my production and sales, it is going to remain same. But there are two types of fixed cost. One is avoidable fixed cost, another is unavoidable fixed cost. Now try to understand concept of unavoidable fixed cost. Say this is my factory. It is having a big 10 acres of land. There is one security person over here, and I pay him salary of 1,20,000 rupees per annum. What I manufacture over here is say pens. Whether salary paid to this security person will be a fixed cost, yes. Because whether I manufacture 2 pens or 2 lakhs pens or 2,000 pens, his the salary is going to remain 1,20,000. It is my fixed cost? Yes. I am asking the owner of the business that if you shut down, if you shut down your plant for a temporary period of time, say for 1 year, 2 years, 5 years, whether this cost can be avoided, so you will not have to hire a security person, or you will still have to hire a security person if you don't manufacture anything. The owner says, I'll have to hire a security person whether I manufacture the pens or don't manufacture the pens. Because the land is very big, it will require at least one security person to whom I need to pay 1,20,000. So even by stopping the production, the fixed cost cannot be avoided. A fixed cost which cannot be avoided even after shutdown. Are unavoidable fixed cost. What is avoidable fixed cost? I asked two businessmen whether you will keep your accountant as it is. If you shut down your business, you will say no. The businessman says no. Then the salary of accountant is avoidable fixed cost. Why? That cost can be avoided if I shut down my business. So cost which can be avoided, fixed cost which can be avoided if business is shut down is avoidable fixed cost. Sir, variable cost, we are not talking about variable cost. Variable costs are always avoidable. If you manufacture, you will be incurring cost. If you don't manufacture, you will not be incurring cost. We are right now talking about avoidable fixed cost. If you close down your business, if you don't manufacture anything, this cost can be saved. And unavoidable fixed cost, even if you shut down your business, even if you manufacture zero product, then also you are going to incur this cost, which is unavoidable fixed cost. So our original cost was 1 lakh. Say 80,000 is avoidable and 20,000 rupees is unavoidable. What does it mean? If I manufacture 5 units, my cost will be 80,000. 5 lakh units, my cost will be 80,000. If I manufacture 0 units, I close down my business, I will be incurring 0 cost? No, still I will be incurring how much cost? 20,000 rupees cost. Because I am having this land, I'll have to pay that security guy. That cost is not avoidable, it is unavoidable fixed cost. Try to concentrate what we are going to learn. We are going to learn shutdown point. How to find out shutdown point? What is shutdown point? I'll explain you, but first how to find out shutdown point. It is avoidable fixed cost upon contribution per unit. Whenever in denominator it is contribution per unit, this answer will be in units and not in rupees. Say my pani puri selling price is 10 rupees, variable cost is 4 rupees, contribution per unit is 6 rupees. I am changing somewhat fixed cost. In original question, I have taken fixed cost of 30,000. Let me take a fixed cost is rupees 1 lakh. It is given out of this 1 lakh rupees fixed cost, 60,000 rupees is avoidable. What does it mean? If I close down the business, 60,000 fixed cost will not incur, but 40,000 fixed cost will still be incurred because the 40,000 is unavoidable fixed cost. The sum is telling you to find out, number 1, break even point in units. Number 2, shut down point in units. How to find out first break even point? That we have done in lecture number 1, right? Break even point in units is equal to fixed cost upon contribution per unit. What is fixed cost? 1 lakh. We are finding out break even point. We are not finding out shutdown point. We need to take 1 lakh. Divided by contribution per unit will be 6. 10 minus 4 will be is equal to 6. So 1 lakh divided by 6. 16,667 units is my break even point. What second answer they want? They want shutdown point in units. What is shutdown point in units? Avoidable fixed cost divided by contribution per unit. What is avoidable fixed cost? 60,000, right? The fixed cost which can be avoided if you shut down your units, divided by 6, which will be 10,000 units. Now, I am drawing that sales number line. 0 to infinite sales in units. What is my break even point? Break even point is 16,667 units. What does this mean? Above this, you will be having profits. At break even point, you will be having no profit, no loss. Below break even point, you will be having losses. See, you have not yet started the business. Your economist says that you are going to sell 18,000 units, 18,000 units. So what your economist says? You are going to sell 18,000 units in next year. What you can assure, if you sell 18,000 units, you will be having profit. You will be having profits. Now your economist says that no, because of Corona, you are going to sell only 19,000 units, not 19,000, let me take it. You are going to sell only 15,000 units. Now, with this forecast, I can say that if I am able to sell 15,000 units, I will be incurring losses. See my question. If my economist says that I will be selling 15,000 units, I know that I will be incurring losses at 15,000 units. But should I continue the business? Sir, it is a very silly question. If you are going to incur losses in next year, you should stop your business. You should shut down your business. Believe me, the answer is no. If my forecast is that I am going to sell 15,000 units, at a loss also I should continue my business. Tell me, what is my shutdown point? Shutdown point is 10,000 units. Anything above shutdown point, I should continue the business. In this area with losses, in this area with profits. Any expectation of sales below shutdown point, I should close down my business. So, shutdown point will help you to take the decision whether you should continue the business or whether you should shut down the business. Sir, still it does not make any sense. at 15,000 units, we are going to incur losses. Why to continue the business? I'll prove it. At 15,000 units, you are having two options. Continue or shut down. If you continue your business, what will be your situation? You will be earning contribution. How much contribution you will be earning? 15,000 units into contribution per unit, which is 6, which is 90,000 rupees. What will be your fixed cost? Contribution minus fixed cost is your profit. Now fixed cost will be 1 lakh. Why 1 lakh rupees? If you continue your business, your fixed cost is not avoidable and unavoidable. When you close down your business, you think about avoidable and unavoidable. You are continuing your business, your fixed cost is rupees 1 lakh. You will be having a loss of 10,000. Ultimately, profit negative is a loss of 10,000. Had you shut down your business, what would have been your contribution? 0. If you shut down your business, your sales will be 0, variable cost will be 0, contribution will 0. Minus a fixed cost, 0. No. You will still be incurring your unavoidable fixed costs. They are not avoidable. They will be still incurred even if you shut down your business. And what are your unavoidable fixed costs? 1 lakh. 60,000 is avoidable. So 40,000 will be unavoidable. So my fixed cost I will be incurring is negative 40,000, which is unavoidable fixed cost. Negative 40,000. So what is better? To have a loss of 40,000 or to have a loss of 10,000? Loss is never good. But which is a better situation? To incur a loss of 10,000 rupees is better. See what decision is coming? Continue. Believe me, at any level of activity above 10,000, you will be continuing your business with losses. Up till this point, break-even point. After break-even point, you will be continuing your business with profit. So the thing is that how shutdown point helps you. At a shutdown point also we are going to do, but first let us understand. Suppose our economist says that you are going to sell only 8,000 units. Let me find out on next page at 8,000 units. I am going to sell only 8,000 units. Believe me, my answer or decision will be to shut down. What is the reason? It is below break-even point. No, break-even point does not give me a good idea whether I should shut down or whether I should not shut down. It just gives me idea whether I will be earning profit or incurring losses, because it is below shutdown. What is shutdown point? 10,000 units. 8,000 units is below shutdown point. So my answer will always be shut down. 8,000 units I am having two options. Continue or shut down. If I continue, what will be my contribution? 8,000 into 6. 48,000 minus fixed cost. 1 lakh. If I continue the business at any level, my fixed cost is going to be 1 lakh. Negative 52,000. If I shut down my business, what will be my contribution? 0. What will be fixed cost? Unavoidable fixed cost. What is unavoidable fixed cost? 40,000. Negative 40,000. Which is better, to have a loss of 52,000 or to have a loss of 40,000? It is better to have a loss of 40,000. And what is my decision? Shut down. I was knowing the decision because the level of activity is below shutdown point. Sir, what will happen at a shutdown point? Your economist says that you are going to exactly sell 10,000 units. Believe me, you are indifferent. At a shutdown point, you will be incurring the same thing. Try to understand. Again, you are having two options: continue, shut down. If you continue, what will be your contribution? 10,000 into 6, which is 60,000, minus a fixed cost. If you continue, your fixed cost will be 1 lakh. What will be answer? Negative 40,000. If you shut down, your answer is going to remain negative 40,000. How? Contribution 0 minus avoidable fixed cost negative. Which will be good decision? To continue or to shut down? That is, you are indifferent. You may continue, you may shut down. You are going to have a losses of 40,000. So, how shutdown point helps? Once again, shutdown point. Below shutdown point, what will be your decision? Close down, shut down. Above shutdown point, you should continue your business. The break-even point will always be above shutdown point. So say this is break-even point. So in this area, exactly in this area, exactly in this area, and exactly in this area, suppose my economist says that I am going to sell this many units in next year. See, what is my decision? If economist says that I am going to have this many units of sales next year, I should shut down. Why I should shut down? I will be incurring more losses as compared to unavoidable fixed cost. So if my unavoidable fixed cost is 40,000, I will be incurring more losses than 40,000, so I should close down. If my economist says that I am going to sell this many units in next year, it is above shutdown point or below shutdown point? Above shutdown point, I will continue my business. Will I shut down or not? No, because it is above shutdown point with losses. There will be losses. Why there will be losses? At this unit of sales, is below break-even point. Below break-even point, you are going to incur losses. But still, it is a good business decision not to close down your business. Why? You are able to cover your avoidable fixed cost. So, some of your unavoidable fixed cost will also be covered. So, at this point, it is advisable to incur losses and continue the business. I am writing down the reason, you go deep somewhat in it, because I am able to cover full avoidable fixed cost. My avoidable fixed cost is fully covered at this level. Now what I will be covering is some my unavoidable fixed cost. So it is always better to cover some of your unavoidable fixed cost, because it is going to incur whether you continue or shut down the business. At this level, there is no question. You should continue with profits. So in previous question, what was your break-even point? Your break-even point was 16,667 units. So if your economist says that you are going to sell 18,000 units, what will be your decision? You will be continuing business with profits. What was your shutdown point? 10,000 units. So if your economist says that you are going to sell 15,000 units, 14,000 units, you should continue the business with losses, but you should continue it. If your economist says that you are going to sell 3,000 units, you should not continue the business because the level of activity is below shutdown point. You are not able to cover at this level, you are not able to cover even your avoidable fixed cost. Then you will be incurring more cost as compared to your unavoidable fixed cost. This is the concept of shutdown point. We can find out shutdown point directly in rupees also. Shutdown point in rupees is avoidable fixed cost upon PV ratio. Anything if you want to find out directly in rupees, it is nothing but divided by PV ratio. Instead of contribution per unit, I will be dividing it by PV ratio. So in our question, it was avoidable fixed cost which was 60,000 divided by PV ratio was 60%, which will be rupees 1 lakh. What was shutdown point in units? 10,000 units. If I wanted to find out shutdown point in rupees, it is 10,000 into selling price per unit, 10 rupees, which is nothing but 1 lakh. Or I could have found out by 60,000 divided by PV ratio will be 60%. 6 divided by 10 multiplied by 100, which is 60%. So 60,000 divided by 60% is also nothing but 1 lakh. This is nothing but concept of shutdown point. Very easy. If you are able to cover your avoidable fixed cost, you should always continue the business. What was the decision making in break-even point? Whether you are earning profits or whether you will be incurring losses. What is the decision in shutdown point? Whether you should continue your business or whether you should not continue your business. That is the decision which shutdown point will give you. Next point, next concept. It is indifference point. It is similar to what you learn in finance as indifference point, but try to concentrate over here. I am having two options to manufacture same type of goods, say pani puri. In one, fixed cost is 1 lakh rupees. In another case, I will be incurring fixed cost of 60,000. So in second B case, I will be incurring less fixed cost. Here I will be incurring more fixed cost. Selling price per unit is 10 because it is pani puri business. Selling price will be rupees 10. Here also will be rupees. But variable cost per unit in first case is 4 rupees. In second case is 6 rupees. Are you able to compare this? A option is higher fixed cost but less variable cost. B option to manufacture the same thing, doing the same thing, lower fixed cost but higher variable cost. Say petrol car, diesel car. This is petrol. This is diesel. Diesel car will be lower in cost. Sorry. This is diesel. This is petrol. Petrol car will be lower in its cost, but its maintenance or petrol expenditure will be higher. Diesel car will be higher in fixed cost, but its petrol maintenance will be lower. This will be 6, contribution per unit will be 6, and this will be. The question is, how much amount of units I am going to sell. And say if I give you a rough idea, I am going to sell say 10,000 units. Whether I should go for technology A or project A, or whether I should go for technology B or project B. What does it mean? Whether I should go for higher fixed cost, lower variable cost, or I should go for higher fixed cost, lower variable cost. Higher fixed cost, lower variable cost, lower fixed cost, higher variable cost. Which type of point I should? First, let me find out indifference point. I'm just telling you the formula for indifference point, and then we'll be understanding it. Indifference point is change in fixed cost divided by change in contribution per unit. What is the difference in fixed cost between two options? 40,000. What is the difference in contribution per unit in two options? 2 rupees. And this will be 20,000. Tell me, it will be units or rupees? It will be units, because you are dividing it by contribution per unit. The answer will be in units. 20,000 units. How indifference point helps? Please try to concentrate over here how indifference point will help. You say this business is of, it is not car, but it is for manufacturing pen. In both the cases, your selling price of pen is going to remain 10. Right? Project A as well as project B. I am drawing again number line of sales in units. Sales in units starting from 0 up till infinite. What is indifference point? Indifference point is 20,000 units. See, again your economist comes and say that in next year you are going to sell 30,000 units. Above this point, which project you should go? In financial language, it is a higher risky project in finance. Here it is higher fixed cost project. Which type of project you should go? Higher fixed cost, lower variable cost at this stage. Higher fixed cost, lower variable cost. So below this, you should go for a project lower fixed cost and higher. I can prove it in this case. If your economist had told that you are going to sell say 30,000 units, you are having two options, either to go for project A or to go for project B. Had I gone with project A, what would be my profit? Contribution would be 30,000 into, what was contribution in project A? 6. 1,80,000 minus fixed cost. What would have been fixed cost in project A? 1 lakh. It is 80,000. This would have been my profit. Had I gone with project B, what would be my contribution? I would have sold 30,000 units. and earned a contribution of 4 rupees. 1,20,000 minus fixed cost. Fixed cost is lower in this case. It is only 60,000. And I would have earned a profit of 60,000. Which is better option? Project A. To earn 80,000 profit is better than to earning 60,000 profit. I would be taking decision of A. Believe me, without calculation also this decision can be taken. How? Which is higher fixed cost, lower variable cost? A. That should be taken if your estimated sales is above indifference point. If your estimated sales is above indifference point. Now, suppose my estimated sales was say 18,000 units. This stage. Estimated sales 18,000 units. Without calculating the answer, believe me, I can say if my estimated sales is 18,000, I should go for project B, which is lower fixed cost, higher variable cost. Lower fixed cost, higher variable cost is project B. I should go for project B. I can tell without calculation, but let me calculate it. If at 18,000 units, I go with project A or I go with project B. It is our option, right? I'm just calculating. If I go for project A type, project B type, what will be my profit? Contribution will be 18,000 into 6, which will be 1,08,000 minus fixed cost 1 lakh. I would be earning profit of 8,000 had I gone for project A type. That is higher fixed cost, lower variable cost. Lower fixed cost, higher variable cost is project B. How much I would have earned? Contribution 18,000 into 4. It is 72,000 minus fixed cost 60,000. I would be earning profit of 12,000 rupees. Which is better, profit of 8,000 or profit of 12,000? Profit of 12,000. Which type I should select? Type B. What is type B? Lower fixed cost, higher variable cost. How indifference point is helpful? Indifference point is helpful to take a decision whether you should go for a project with higher fixed cost, lower variable cost, or lower fixed cost, higher variable cost. Above indifference point, higher fixed cost, lower variable cost project should be taken, and below lower fixed cost, higher variable cost should be taken. This is nothing but the concept of indifference point. Let me incorporate all three concepts. Concepts of break-even point, concept of shutdown point, and concept of indifference point, and let us try to understand it. In the same question, I am telling you that avoidable fixed cost in both these cases. Avoidable fixed cost is say 20,000. So in this case, 80,000 is unavoidable fixed cost, and in this case, 40,000 is unavoidable fixed cost. In both the cases, avoidable fixed cost is 20,000. So if you close down your business, you can save only your accountant salary, which is 20,000 per annum. I am taking same question. I am finding out a shutdown point for project A, for a project B. I am finding out a break-even point for project A, project B, and I am finding out indifference point. Indifference point will be common for project A as well as project B. So let me find out break-even point. Everything in units. I don't want any answer in rupees. Project A, project B. Fixed cost divided by contribution per unit. 1 lakh divided by 6. It is 16,667 units. Fixed cost divided by contribution per unit, 60,000 divided by 4. Will be 15,000 units. It is break-even point in units. Let me find out a shutdown point for A and B. Shutdown point in units. What is the formula for shutdown point in units? Avoidable fixed cost divided by contribution per unit. So avoidable fixed cost is 20,000 rupees divided by contribution per unit is 6. Which is 3,333. Shutdown point of B, 20,000 divided by 4. Am I right? Yes, because avoidable fixed cost in both the cases we have taken as 20,000. So 20,000 divided by 4. It is 5,000 units. Third, what is indifference point? Indifference point cannot be of project A. It will be of two projects. Two projects indifference point. It is, we have already found out indifference point, which is 20,000 units. And now I am plotting a full-fledged my estimated sales graph in units. Try to concentrate. This is the sales in units and this is 0. I want the lowest figure of all this. It is 3,333. So I'm drawing it over here. 3,333 units. It is shutdown point for A. Then 5,000 shutdown point of B. 5,000 units shutdown point of B. Break even point of A, 16,667. No, 15,000. Break even point of B. Then 16,667. 16,667 units. Break even point for A. And then 20,000 units. Is indifference point between A and B. What is project A? Higher fixed cost, lower variable cost. Project A, higher fixed cost, lower variable cost. Project B, lower fixed cost, higher variable cost. what indifference point takes a decision? Try to concentrate. If your estimated sales is above indifference point, if your economist says that your sales will be above 20,000 units, that is at this stage. Let me change the color. At this stage, you should go for project A. Why? It is having higher fixed cost, lower variable cost. You are easily able to cover your fixed cost, and so you will be earning your more profit as compared to lower fixed cost, higher variable cost, and that we have proved even. So try to understand, as a owner of the business, as a CEO of the company, if you are having this details, how fast you can take the decision. There are two options: to purchase machinery A, to purchase machinery B. Machinery A higher in fixed cost, lower in variable cost. Machinery B lower in fixed cost, higher in variable cost. Say one is capitalist, one is labor intensive. Your estimated sales, your board members are saying you that, sir, our estimated sales is 50,000 units. You can directly take a decision: we should go for machinery A and not machinery B. We should go for capitalist and we should go for capital oriented unit rather than labor oriented unit. So by this you can take a decision fast. Please understand, at this level, I'm talking only about this gap. It is below indifference point or it is higher than indifference point. It is below indifference point, lower than indifference point. I should go for project B, which is lower in fixed cost, higher in variable cost. My point is, if I am going for project B at this stage, will I be earning profits or loss? Believe me, I would be earning profits. What is the break-even point of project B? 15,000 units. So above this, I will be always earning profits. But the point is, at this stage, had I gone for project A, would I have incurred losses? No, I would have still earned profits. Why? This stage is greater than even break-even point of project A. So this is break-even point of project A. This point is greater than break-even point of project A. So you will be earning profits had you gone for project A. But that profits would be less than project B. So what is a good idea? Less than indifference point, go with project B, lower fixed cost, higher variable cost. All right. I am going to this stage. Exactly this portion. My estimated sales is between 15,000 and 16,667. Should I go with project A or project B? Always when there is an option, go with project A or project B. See your indifference point. Don't see your break-even point and such thing. See your indifference point. Indifference point is 20,000 units. This level is less than 20,000 units. I will always go with project B. Will I be earning profits? Now you will have to see break-even point of project B. It is above break-even point of project B, and so I should go for project B, and it will be having profits. Why? The level of activity is higher than break-even point of project B. Had I gone for project A, I would have earned profit or incurred losses. Then I would have incurred losses. Why? This level is less than break-even point of project A. So instead of earning profits, you would have gone for losses, and so you are selecting project A. Sir, whether to select project A or project B, we need to take a call of break-even point? No. What can help you? Only one point, that is indifference point. Above indifference point, project A. Below indifference point, it will be project B. Alright, I am going to next, this one. If my estimated sales is between 5,000 units and 15,000 units, which project I should go? A or B? Less than indifference point B, more than indifference point A. It is less than indifference point, so it will be project. In project B, I would be incurring losses or profit? In project B, I would be incurring losses. Sir, then should we not select project A? The answer is no, because it would result into more losses. Sir, then why should we not shut down the business? Should we not shut down the business? No, because the point is above shutdown point of B. See this. This is above shutdown point of B. Then you should shut down the business or not shut down the business? No. Why? If you shut down the business, you will be having more losses. So which project? Project B. And now we are going to extremely good situation. Try to concentrate over here. See, should I go for project A or B? Technically, I should go for project B. If my level of activity is between 3,333 and 5,000 units, I should go for project B. Will I be earning losses? Yes. But it is better to shut down your business because it will be having less losses. See, what is project B shutdown point? This. You are working below project B shutdown point. Yes. So project B is now cancelled. Shutdown point will result into less losses. So you should shut down the business. But is it better to go with project A? Yes. Why? This level is above shutdown point of project A. In project A, whether there will be losses? Yes, but it will be least losses. Which least losses? As compared to going for project B, compared to shutting down project B, and as compared to project A. So project A should be done because it is above project's A shutdown point. Now this is very interesting, right? With losses also you are continuing higher fixed cost, lower variable cost business, which is having higher unavoidable fixed cost. At this, A, no. B, no. You should shut down. Why? This level is below shutdown point of A also and shutdown point of B also. So, what break-even point helps us? Above break-even point, I will be incurring profits. Below break-even point, I will be having losses. This is the use of break-even point. You cannot take a decision whether you should go for project A or project B by this figure. You cannot take the decision whether you should shut down or continue the business by break-even point. Second idea, shutdown point. How it will help you out? Below shutdown point, you should shut down your business. Above shutdown point, you should continue your business. Whether with profit or loss, you will have to see break-even point. But a shutdown point helps you to take a decision that below shutdown point, if it is estimated sales, you should shut down your business. Above shutdown point, if your sales is estimated, then you should continue the business. Yes, whether it will be profit or loss, again you will have to see break-even point. Last was indifference point. Above indifference point, higher risk, so higher fixed cost, lower variable cost project should be selected. And below indifference point, lower fixed cost, higher variable cost project should be selected. Sir, whether to shut down or not, this decision cannot be taken by indifference point. Whether I will be earning profits or loss, this decision cannot be taken by indifference point. Which decision can be taken by indifference point? If you decided to continue your business, and if you are continuing the business with two options, higher fixed cost, lower variable cost, lower fixed cost, higher variable cost, which project, labor intensive, capital intensive, higher fixed cost, lower variable cost, lower fixed cost, higher variable cost, which project you should do, which point will help you? Indifference point will help you. How to find out break-even point? In units is fixed cost divided by contribution per unit. How to find out a shutdown point is in units. If you are able to cover your avoidable fixed cost, so avoidable fixed cost will be numerator divided by contribution per unit. How to find out indifference point in units? It is difference in fixed cost divided by difference in contribution per. And also difference in contribution per unit, 6 and 4. What is the difference? 2 rupees. Will always be difference of variable cost because selling price is going to remain same. Both are same project. So you can write down instead of difference in contribution per unit, you can also write down difference in variable cost per unit. So I can write down or difference in fixed cost divided by difference in variable cost per. And this will be end of all the concepts which are going to come in your marginal costing. So now let us revise all the formulas that we have done in marginal costing, starting from contribution per unit. Let us make it colorful. Contribution per unit is a selling price per unit minus variable cost per unit. A very basic formula. Also, we have understood variable cost per unit can also be found out by difference in total cost upon difference in output. Because whatever is the difference in total cost is always because of variable cost. I can get the answer of variable cost per unit. Then we understood PV ratio. How to find out PV ratio? Total contribution upon total sales multiplied by 100, or contribution per unit upon selling price per unit multiplied by 100, or difference in contribution upon difference in sales multiplied by. and most important, or difference in profit, because fixed cost is going to remain same, upon difference in sales multiplied by, I can find out the PV ratio. Break even point in units will be fixed cost upon contribution per. Break even point in rupees. How much sales I should do so that there is no profit, no loss? Fixed cost divided by PV ratio. Whenever the answer is to be found out in rupees, the denominator will be PV ratio. Break even point in rupees can also be found out by break even point in units multiplied by selling price per. Then sales for desired profit in units will be fixed cost plus desired profit upon contribution per unit, because I want to find out answer in units. Then sales for desired profit in rupees. What should you sell if you want this much profit? This type of questions is a fixed cost plus desired profit upon PV ratio. This can also be found out by sales for desired profit in units multiplied by selling price per. Then we went into concept of PV ratio, margin of safety. So margin of safety in units. What is margin of safety? Difference between actual sales minus break even point. If you want to find out in units, this will be in units. Margin of safety in rupees will be again actual sales in rupees minus break even point in rupees, or margin of safety in units multiplied by selling price per. Margin of safety in percentage. It is margin of safety upon sales, actual sales into 100. Sir, in rupees or in units, if you take numerator in units, denominator in units, if you take numerator in rupees, denominator in rupees. Also, we have understood this, if you remember, margin of safety in units multiplied by contribution per unit is nothing but profit. Your break even point covers your fixed cost. Anything above your break even point covers your profit, and margin of safety is a sales beyond break even point, is nothing but your profit. Also, we have understood break even point in units multiplied by contribution per unit is nothing but fixed cost. And we always know that actual sales in units multiplied by contribution per unit will be total contribution. Total sales in units multiplied by contribution per unit is total contribution, or it is the profit plus fixed cost. The same is true for PV ratio. So margin of safety in rupees multiplied by PV ratio will be profits. Break even point in rupees multiplied by PV ratio will be fixed cost. And actual sales in rupees multiplied by PV ratio will be total contribution or profit plus fixed cost. Profit plus fixed cost is nothing but total contribution. Your break-even points covers your fixed cost, and any sales above break-even point covers your profit. Then we understood a shutdown point. Shutdown point in units is avoidable fixed cost upon contribution per. We understood shutdown points in rupees. Even if we have not understood it, it is nothing but avoidable fixed cost upon PV ratio. If the answer is to be found out in rupees, we need to take the percentage in rupees terms, that is PV ratio. Or it is shutdown point in units multiplied by selling price per. Then we understood indifference point in units. How to find out? Difference in fixed cost, not avoidable and unavoidable, divided by difference in contribution per, or difference in fixed cost upon difference in variable cost per. Because difference in contribution per unit will be always difference in variable cost per unit, selling price per unit remaining same. These are all the formulas of marginal costing. I hope we have understood logically all the formulas, also the concept, how it will be helpful. Indifference point, if your estimated sales is less than indifference point, lower fixed cost, higher variable cost, more than indifference point, higher fixed cost, lower variable cost. Break even point, lower than break even point, you will be incurring losses. More than break even point, you will be incurring profits. Shutdown point, less than shutdown point, you should close down your business. More than shutdown point, if your estimated sales is, you should continue your business. Margin of safety, how much percentage more if you go beyond your what will be margin of safety is difference between actual sales and break even point sales. That is by how much percentage if you go on a negative side, still you will after which you will be incurring losses. So if your margin of safety is 20%, if your sales goes down by 18%, you will be still in profit zone. If your sales goes down by 22% and if your margin of safety is 20%, you will be start incurring losses. Margin of safety, we have understood all the point. Desired profit, how much sales I should do to earn this much profit in units as well as in rupees. Everything we have understood logically. And now after understanding logically, this all formulas should be at a tip of your tongue to solve the questions of marginal costing. With the expectation that you all are knowing all the formulas of marginal costing, let us start with questions of marginal costing. 14.1. Product Z has a profit volume ratio of 28%. Fixed operating cost directly attributable to product Z during a quarter 2 of the financial year is 2,80,000. So 2,80,000 is a fixed cost for a quarter. Calculate sales revenue required to achieve a quarterly profit of 70,000 rupees. Now, try to understand, break-even point is always based upon either 1 month, either 6 months, either 1 year or a quarter. So what does break-even point say? Break-even point 2,000 units. What does this mean? Whether you have taken fixed cost of a year, then this break-even point means that in a year, if you sell more than 2,000 units, you will be earning profits. If you have taken fixed cost for a month, what does this mean? In a month, if you are selling more than 2,000 units, then you are earning profits. So here both are quarterly, right? Fixed cost is also quarterly and question required is also quarterly. You can directly solve the question. I'll be directly using the formula for sales in rupees for desired profit, which will be fixed cost plus desired profit upon PV ratio. I'll be directly getting answer in rupees. Fixed cost is 2,80,000 rupees plus desired profit is 70,000 upon PV ratio is 28%. 2,80,000 plus 70 is 3,50,000. 3,50,000 divided by 28%. 12,50,000 rupees. You should write down rupees. The answer is in rupees. What does this mean? If in one quarter you will be doing sales of 12,50,000 rupees, then you will be earning a profit of 70,000 rupees in a quarter, not a year, not a day, not a month. In a quarter, to earn a profit of 70,000 rupees, in a quarter you will have to do a sales of rupees 12,50,000. If both the figures were in year, it would be yearly figure. If both the figures were in months, it would be monthly figure. This is very easy question. 14.1. Next, 14.2. ABC Limited started its operation in a year with a total production capacity of 2 lakh units. The following information for 2 years are made available. Sales in units, total cost in rupees. There has to be change in cost structure and selling price, and it is anticipated that it will remain unchanged in year 3 also. So there has been no change. It should be like this. Selling price is given. It is 40 per unit. Calculate variable cost per unit, PV ratio, break-even point in units, profit if the firms operates at 75% capacity. Let us find out first answer. If we know the level of activity under both the cases, and if we know total cost under both the cases, we can easily find out variable cost per unit. Variable cost per unit is a difference in total cost upon difference in sales. Difference in total cost will be 34,40,000 minus 45,60,000 is 11,20,000. And difference in production or sales, 80 and 120 is 40,000. What I will be getting is variable cost per unit, which will be 11,20,000 divided by 40,000, which is 28. I have got first answer. Second answer, PV ratio. PV ratio. I will be finding out by contribution per unit upon selling price per unit multiplied by 100. Contribution per unit will be 40 minus 28. Selling price minus variable cost per unit divided by selling price given is 40 multiplied by
40 minus 28 divided by 40 multiplied by 100. It is 30%. Break-even point in units. How to find out break-even point in units? Fixed cost upon contribution per unit. Numerator I am not having, denominator I am having. Denominator is 40 minus 28. It is 12. Fixed cost I need to find out. Concentrate. I know variable cost per unit is 28. Let me take year 1. How many units I have produced and sold? 80,000. So 80,000 into 28 is my total variable cost. Which is 22,40,000. What is the total cost of a first year? 34,40,000. Total cost minus total variable cost will be total fixed cost. And fixed cost remains same in each year. So even if you will find out of year 2, you will be getting the same answer. This is 12 lakhs. So total fixed cost is 12 lakhs rupees. 12 lakh divided by 12 is 1 lakh. Always write down units or rupees. It is units. Break-even point in units is done. Profit if a firm operates at 75% capacity. What is your total capacity? 2 lakhs. Profit if firm operates at 75% capacity. Answer number 4. At 75% capacity, how much you will be selling? 2 lakh multiplied by 75%, which is 1,50,000 units. 2 lakhs is units, right? Yes. You will be selling 1,50,000 units. Then see how to find out profit is very simple. Contribution minus fixed cost is nothing but profit. I will be using the same concept. Contribution, total contribution will be 1,50,000 into contribution per unit is 12, which is 18 lakhs, minus fixed cost 12 lakhs. These are rupees. I will be earning a profit of 6 lakhs. Again, a very simple question, nothing more to understand in this, but a good question for practice. It is asked 2 times in examination, May 2009 and May 2015. C 14.3. Following details are related to XYZ Limited. Total cost is given. So it is fixed plus variable. Total. Margin of safety in rupees is given. Margin of safety in units is given. And break-even sales in units is given. So break-even point in units is given. You are required to calculate profit. Profit volume ratio. Break-even sales in rupees. Fixed cost. So practically everything. So first let me find out. Margin of safety in rupees is given and in units is given. I can find out selling price per unit. How? Margin of safety in units multiplied by selling price per unit is nothing but MOS in rupees. MOS in units is the 6,500 into selling price will be MOS in rupees is 48 lakh 18,450. So selling price per unit, this is working note number 1. Selling price per unit will be 48 lakh 18,450 divided by 6,500. Divided by 6,500. 741.3. Actual sales is not given, right? Okay. Let me also draw this number line. You can always draw number line in your answer. No need to do it in working note. This is my break even point. This is my actual sales. And this portion is my margin of safety, which is 6,500 units. I am having selling price, but now I am not having PV ratio. Actual break even point in units I think is given. Break even sales in units is 3,500 units. Margin of safety is 6,500. So actual sales will be 10,000 units. So I can find out actual sales in rupees also. Actual sales in rupees will be 10,000 into 741.3, which is selling price per unit. Hmm, 10,000, let me do it in calculator. 10,000 into 74 lakh 13,000. It is actual sales. BEP in rupees is also given. I can directly multiply it with 741.3. BEP in units multiplied by selling price per unit is BEP in rupees. So I'll be getting this third answer. 3,500 into 741.3. 25 lakh 94,550. 25,94,550. This is BEP in rupees. This is actual sales in rupees. So third question I have got the answer. Profit. I can easily find out because I am having actual sales. And I am having total cost. Yes, what is fixed and variable we don't know, but I am having total cost, right? So actual sales and total cost, if I compare, I will be getting first answer, which is profit. So actual sales minus total cost is equal to profit. Actual sales is 74 lakh 13,000. Minus total cost is 5678. So my profit will be 17 lakh 35,000. I've got first answer, which is profit. Now I need to get my answer of fixed cost and PV ratio. And PV ratio will be interesting. Try to understand, are we having margin of safety in rupees? Yes. It is 48 lakh 18,450. 50 rupees. Please understand, I am having margin of safety in rupees. From margin of safety, if I want to find out profit, you remember, I can multiply PV ratio and I can get profit. We are having one formula. Margin of safety in rupees multiplied by contribution ratio. PV ratio is a contribution ratio. But your break-even point has already covered your fixed cost. So the remaining is only your profit. Will be is equal to profit. Now margin of safety in rupees you are having 48, 18, 450. PV ratio you are not having, but profit you are having. So I will be getting answer of PV ratio, which is 17,35,000 divided by 48,18,450. It is 0.36007, which is equal to 36%. Now, I have found out PV ratio. I need to find out fixed cost. There are n numbers of ways by which you can find out fixed cost. What I feel is, I am having PV ratio, I am having break-even point. Break-even point in rupees is nothing but a fixed cost upon PV ratio. Break-even point in rupees I am already having 25,94,550. Multiplied by PV ratio will be 36%, will be is equal to fixed cost. So fixed cost will be rupees 9,34,038. Now, what is the total variable cost? No need to find out. Whatever questions they have asked, I need to find out the answer. Which formulas were important? Margin of safety in rupees multiplied by PV ratio is profit. What was given? Margin of safety in rupees was given and PV ratio was given. Profit was given. What was expected was to find out PV ratio. Break-even point in rupees was given and PV ratio we had found out. But what was expected is to find out fixed cost. So even if you know all the formulas, application of formulas will be equally important. This is 14.3. Next one. 14.4 is somewhat easy. Margin of safety in rupees is given, is in quantity given. I can find out selling price per unit. It will be similar type of question. Selling price per unit will be is equal to rupees 3,75,000 divided by 15,000 units. 3,75,000 divided by 15,000. 25. Break-even sales in units is given. $5,000 units. So break-even point in rupees will be 5,000 into 20. Will be 1,25,000. Total cost is given. I can easily find out profit. Profit is equal to actual sales minus total cost. Total cost I am knowing. Total cost is 387. Actual sales I need to find out. What is break-even point? 1,25,000. What is margin of safety in rupees? 3,75,000. So 1,25,000 plus 3,75,000 is actual sales. Can I say MOS is actual sales minus break even point? MOS is given 3,75,000. Actual sales we need to find out, and break even point in rupees we are having. So actual sales will be 3,70,000 plus 1,25,000, that is 5 lakhs. Actual sales is 5 lakhs rupees. So 5 lakhs minus 387,500, 1,12,500. Profit. Selling price per unit I have already got. PV ratio, if I am having margin of safety in rupees, MOS in rupees multiplied by PV ratio is profits. I am having profit 112,500. I don't have PV ratio, but I am having margin of safety in rupees 3,75,000. I will be getting PV ratio 1,12,500 divided by 3,75,000. It is 0.3 or 30%. I have got PV ratio, break even point in rupees I have already found out, and a fixed cost I can easily find out. Break even point in rupees is a fixed cost upon PV ratio. Break even point in rupees is 1,25,000. Fixed cost I need to find out. PV ratio is 0.30. 37,500. Always write down rupees. If you don't write down rupees, they'll cut your marks. You are dealing between units and rupees, so you always need to specify what answer you are writing it down. Exactly third and fourth questions are same. It is just for practice. Now this will be good. 14.5. You need to clearly understand the question to solve it. A company has introduced a new product and marketed 20,000 units. So you will be probably selling 20,000 units. Variable cost of the product is 20 per unit. So variable cost will always be fixed. Will always be known. Why? You know at what rate you are producing your product. And fixed cost is 3,20,000 overhead or cost. You are required to calculate a selling price per unit to earn a profit of 10% on sales value. Then you need to find out break-even point and margin of safety. So, how you will be determining your selling price? In normally all the questions selling price will be given. In this question, you need to find out selling price per unit to earn a profit of 10% on sales value, right? So, what will be your sales? 20,000 units into X. 20,000 units into X, where X is a selling price per unit. And how much profit you want? What will be sales? 20,000 X. What profit you want? 10% on sales value. 20,000 X is your sales value. So you want 20,000 X into 10% as your profit. So you want a profit of 2,000 X. If your sales is 20,000 X, what will be variable cost? Variable cost is final. 20,000 into 20. which is 400, 4 lakhs rupees. I'm not finding out contribution. It is not required at this stage. Minus fixed cost. Sales minus variable cost minus fixed cost. What is fixed cost? 3,20,000. Should be my profit, which is 2000x. I can form an equation. 20,000x minus 7,20,000 is my total cost. Variable cost 4 lakh. 3,20,000 will be fixed cost. So 7,20,000 should be is equal to 2000x. Solve this equation, you will be getting answer of x will be 7,20,000 divided by 18,000. So your selling price should be 40 rupees. X is nothing but selling price per unit. So 40 rupees is nothing but selling price per. By which formula we have solved? No formula. It is just a puzzle given which we need to solve it. And this was a good point. You can directly even create a formula. If your selling price is X, sales value will be 2000X minus variable cost minus fixed cost should be is equal to 2000X. Selling price is 40 per unit to earn a profit of 10% on sales. Then find out your break-even point. I am finding out my break-even point. Now, what selling price should I take? 40. Because I have decided that I will earn 10% profit on sales value. So, my selling price is 40. My variable cost per unit is 20. So, my contribution is 20. I want a break-even point. Fixed cost upon contribution per. Fixed cost is 3,20,000. Contribution is 20. 16,000 units. Break even point in rupees will be 16,000 into 40 will be 6,40,000 rupees. They have not told me whether it should be in rupees or units, so I am finding out both. Break even point. They are asking me margin of safety. For that, I need actual sales. How to find out actual sales? Very easy. What is my sales? 20,000 into X. Now, X value I am knowing. X is 40. So, 20,000 into 40 is my actual sales, where I am earning a profit of 10% on sales value, which is 8 lakhs rupees. If I sell of 8 lakhs, I am earning 10%. That is 80,000 as profit. So my sales, actual sales is 8 lakhs rupees. Margin of safety will be easy. Margin of safety in rupees is actual sales minus BEP sales. Actual sales is 8 lakhs and BEP sales is 6 lakh 40,000. So it will be rupees 1 lakh 60,000. I can easily find out margin of safety in units will be 1,60,000 divided by 40 will be 4,000 units. Rupees converted into units. Question number 1 I have absolutely solved. So this is answer number. If the selling price is reduced by company by 10%, now we know the selling price. Selling price is 40 rupees. If selling price is reduced by company by 10%, so selling price is made 36. Demand is expected to increase by 5,000 units. All right. Let me take answer number 2. Selling price will be 40 minus 10% will be 36. Variable cost per unit remains same. Variable cost per unit, say my pani puri per dish was costing 6 rupees or 4 rupees. If my selling price was 9 rupees or 10 rupees, it will remain 4 rupees. So variable cost per unit will remain 20. Contribution per unit instead of 20 will become putting 36 minus 20, 16. And my actual sales will be 20,000 units. Already I was selling. Because I have reduced my selling price, the demand will increase by 5,000 units. So I will be selling 25,000 units. They are asking me profit. Yes, what will be impact on profit? I need to find out impact on profit. So I need to find out profit over here also. Impact on profit. Let me find out first profit. If I sell 25,000 units with a contribution of 16 rupees, my total contribution will be 25,000 into 60. Where's 4 lakhs? Minus fixed cost. Fixed cost is not changing. It is 3,20,000. My profit will be 80,000. What was my profit over here? This was my profit, 2000x. And what was x was 40. So my profit over here was 2000 into 40, which was 80,000. See why I'm asking, why I'm finding out current profit, because they asked me this. They are not asking me what will be its profit. They are asking me what will be impact on the profit. There will be no impact on the profit. There will be no impact on total profit. Because it was 80,000, now also it is remaining 80,000. What will be break even point margin of safety? Break even point will be found out again. Break even point in units will be fixed cost 3,20,000 divided by contribution per unit will be 20,000 units, or 20,000 into 36 rupees. $7,20,000 will change. What was your break even point before? 16,000 and 6,40,000. Now it is 20,000 and 7,20,000 rupees. And your margin of safety, MOS in, let me find out first in rupees. MOS in rupees will be actual sales. Actual sales will be 25,000 units into 36 rupees minus break even sales is 7,20,000. 25,000 into 36, so actual sales is 9 lakh minus 7,20,000. It is 1,80,000. There is a change in MOS also in rupees. MOS in units can also be found out. which will be rupees 1,80,000 divided by selling price 36, which is 5,000. That is 14.5. One more point left. Third, calculate margin of safety if profit is rupees 64,000. First, you will have to take situation number 2 or situation number 1. You will have to take situation number 1. Now you will not decrease your selling price by 10%. You will be keeping this original figures, selling price, contribution. So, answer number 3. If my selling price is 40, variable cost is 20, contribution is 20, what will be my margin of safety if profit is 64,000? If profit is rupees 64,000, what will be my margin of safety? All right. Can I write down margin of safety in rupees multiplied by PV ratio? Margin of safety in rupees multiplied by PV ratio is profits. Profits I am knowing 64,000. PV ratio I can easily find out. 20 divided by 40 multiplied by 100 will be 50%. PV ratio is 50%. Margin of safety I will be getting. Margin of safety in rupees will be 64,000 divided by 50%. 1,28,000. And margin of safety in units can be also found out. 1,28,000 rupees divided by 40. 3,200. Sir, can't we take this situation for problem number 2? Normally not. You should take the original situation. Now actually this point should be given over here, right? But as it is not given over here, we will not reduce our selling price and assume that this is my profit. You can even write down in your answer. Assume the profit 64,000 assumed in situation 1. And this will be my answer. Sixth one. PV ratio of Delta Limited is 50%. Margin of safety is 40%. Margin of safety is 40%. Actual sales is given, yes. Company sold 5,000 units for rupees 5 lakhs. Actual sales 5 lakh rupees. Selling price per unit is 5 lakh divided by 500 is 1,000. It is 5 lakh divided by 5. I want to find out break-even point. Margin of safety, let me first find out. Margin of safety in rupees will be actual sales into 40%. So 5 lakh rupees into 40 percentage will be margin of safety. 1 lakh rupees. Sir, where we got this? From margin of safety percentage formula. Margin of safety in percentage is margin of safety in rupees divided by actual sales in rupees into 100. So actual sales multiplied by margin of safety in percentage will be margin of safety in rupees. This is MOS in rupees. I can easily find out break even point in rupees, which will be actual sales minus margin of safety. Actual sales is 5 lakhs minus margin of safety is 1 lakh. Break even point in rupees will be 4 lakh. They have not told me rupees or units. I will be finding out break even point in units also. Break even point in units will be 4 lakhs rupees divided by this 1000 will be 400 units. Sales in units to earn a profit of 10% on sales. Now this is always advisable to do with equation. Sales in units, am I having selling price? Yes. I can easily find out PV ratio, right? How I can find out PV ratio? Because I am having MOS in rupees. Let me find out MOS in units also. It will be 1 lakh rupees divided by 1000 will be 100 units is MOS in rupees. Units. Yes. Yes, sorry, thank you. MOS in rupees is 2 lakhs. 5 lakh into 40% is 2 lakhs. Yes. If this is 2 lakhs, this will be 200 units. If this is 2 lakhs, this will be 3 lakhs rupees. If this is 3 lakhs rupees, this will be 300 units. Now it is all right. Break even point in units will be 300 units. Break even point in rupees will be 3 lakhs rupees. And margin of safety in units is 200 units. I can find out contribution per unit by this. Margin of safety I can find out break even point in units. I am not having fixed cost. Contribution per unit. PV ratio given 50%. I can use this. Break even point in rupees is a fixed cost divided by PV ratio. Break even point in rupees is 3 lakhs. Fixed cost upon PV ratio is 50%. Fixed cost will be 1 lakh 50,000. I can also find out contribution per unit. Break even point in units is equal to fixed cost upon contribution per. Break even point in units is 300. Fixed cost is 1 lakh 50,000 divided by contribution per. You can find out by n numbers of ways. This is not the only way. Contribution per unit will be 50 rupees. It is 50 or 500? It should be 500. Break even point is 300. It should be 500 rupees. You can even find out from PV ratio. You are having selling price per unit which is rupees 1000. So contribution will be 500 because PV ratio is 50%. Sales in units to earn a profit of 10% on sales. to earn 10% profit on sales, let units sold be X. So my sales will be X into, can I write down? My contribution will be X into 500, which is 500X, minus a fixed cost is 1,50,000, should be my profit, and I want 10% profit on sales. What is my sales? 1000X into 10%. I want profit of 100X. I'm forming the equation 500X minus 1,50,000 should be is equal to 100X. So X will be 1,50,000 divided by 400 is 375. If I sell 375 units, I would be earning 10% profit on sales. Now I am writing down the proof, not required in examination. I am just writing it down. If you sell 375 units, multiplied by 1000 will be your sales, which is 3,75,000 rupees. Minus variable cost will be 375 into 500, which will be 1,87,500. So you will be earning a contribution of 1,87,500 minus fixed cost. Fixed cost is 1,50,000. So you will be earning profit of 37,000. How many units you are selling? 375. What is your sales value? 3,75,000. What is your profit? 37,500. See, profit is 10% of sales. So our answer is correct. This is the proof that our answer is correct. You don't need to do this in examination. You need to write down only this answer. X is 375. So before starting the session, let us revise all the formulas that we have done, starting from contribution per unit. Contribution per unit will be selling price per unit minus variable cost per unit. Let us all write down and then revise, right? We also know PV ratio. It is contribution divided by sales multiplied by 100. You can take total contribution, you can take total sales. If you want to take contribution per unit, you will have to take selling price per unit. If you want to take change in contribution, you will have to take in denominator change in sales. So contribution can be total contribution or change in contribution or total sales. Let me not write down in this manner. But it is contribution divided by sales multiplied by 100. Also, one formula says the change in profit divided by change in sales into 100, because change in contribution and change in profit will always be same because fixed cost is remaining same. This is PV ratio. Then we understood break even point in units, which was fixed cost divided by contribution per. Break even point in rupees is a fixed cost divided by PV ratio. Then we also understood concept of desired profit. It is a fixed cost plus desired profit upon contribution per unit. The answer will be in units. Then desired profit in rupees is fixed cost plus desired profit upon PV ratio. Then we understood margin of safety. What is margin of safety? Actual sales minus BEP sales. If you want in units, actual sales should be in units, BEP should be in units. If you want in rupees, actual sales should be in rupees and BEP should be in rupees. MOS in percentage is MOS divided by actual sales multiplied by 100. From MOS, we understood a very good point is if MOS is in rupees multiplied by PV ratio will be nothing but profit. And if MOS is in units, units is never multiplied with PE ratio. It is multiplied with contribution per unit. Then also you will be getting answer of profit. This will be used today in n number of questions. After margin of safety, we also understood shutdown point. What is shutdown point? Avoidable fixed cost divided by contribution per unit. If your expected sales is less than shutdown point, you should close down your business. If your expected sales is above your shutdown point, even if you are incurring losses, you should continue the business. The answer will be in units. Shutdown point in rupees, same thing, avoidable fixed cost upon PV ratio. Then we also understood indifference point. What is indifference point? Below indifference point, if there is your if expected sales is below your indifference point, you should select a project having lower fixed cost, higher variable cost, less risky project. And if your expected sales is above indifference point, you should select a project with higher fixed cost, higher risk and lower variable cost. How to find out indifference point is difference in fixed cost upon difference in contribution per unit, or difference in fixed cost divided by difference in variable cost per unit. A difference in contribution and difference in variable will remain same. And these are the conceptual things that we have learned in marginal costing. Please understand, this does not mean that if you know the formula, you will be knowing the sum. But it is 100% sure if you are not knowing the formula, you will never know the sum. If you are knowing all the formulas logically, there are good chances that you can solve the questions easily. Question is C14.7. A manufacturing concern was operating at a margin of safety of 40%. So margin of safety is 40% in the previous year and was selling its product at 75 per unit. Variable cost ratio to sales was 80% and fixed cost amounted to 5,40,000. So selling price is given, variable cost per unit is given, fixed cost is given. I can find out a PV ratio easily. Yes, I can find out even variable cost per unit. Let me of previous year. So let me solve something of previous year. The selling price of the product is 75. Variable cost ratio is 80% minus variable cost will be 80% of 75. 75 into 0.8, that is 60. My contribution will be 15. Contribution per unit will be 15. I can easily find out break-even point. Break-even point will be is equal to fixed cost upon contribution per unit This answer will be in units. Fixed cost given is 5,40,000 divided by 50. Answer will be 5,40,000 divided by 50. 36,000. Units. Rupees. Break-even point in rupees will be 36,000 into 75. 36,000 into 75. 27 lakhs. Also, margin of safety is available. I can find out actual cost. MOS in percentage is equal to break-even point divided by actual sales. MOS in percentage is 40%. So now I am not multiplying it with 100, so I am writing 0.4. Break-even point in rupees is 27 lakhs rupees. So I will be getting answer of actual sales. Actual sales is 27 lakh divided by 40%. 67 lakh 50,000. $67 lakh 50,000. This is my actual sales. So I have done some calculations of previous year without understanding what is asked in the question. In the next year, the concern anticipates an increase in variable cost and fixed cost by 15% and 5% respectively. Find out the selling price to be fixed in next year, keeping in the view that the concern is willing to maintain the same PV ratio as was in previous year. So all this calculation probably was not required. I have done it. What is required was PV ratio. PV ratio is contribution upon sales multiplied by 100. Contribution upon sales is 15 divided by 75 multiplied by 100. So my current PV ratio is 20%. I want to maintain, find out the selling price to be fixed in next year, keeping in the view that concerned is willing to maintain the same PV ratio in previous year. So let me go to next year. In next year, my selling price should change because my variable cost is changing. I will be getting answer of contribution and my PV ratio should be 20%. This is what is given. Find out the selling price to be fixed in the next year, keeping in the view that the concern is willing to maintain same PV ratio as was in previous year. So I want a PV ratio of 20%. What will be my variable cost? Try to understand. What was variable cost to manufacture one dish of pani puri? Was 60 rupees? One dish of pani puri. Is your variable cost increasing? Yes. Then variable cost per unit will increase. If a fixed cost is increasing, total fixed cost will increase. If variable cost is increasing, your potatoes, your chana, your water is becoming costlier, your variable cost per unit will increase. And variable cost is increasing by 15%. So your variable cost will be 60 plus 15%. 60 plus 15% is 69 rupees. It is 60 plus 15%, 69 rupees. Now it is very simple. If my selling price is 100, my contribution should be 20. So that my PV ratio will be 20%. If my sales price is 100, my contribution should be 20, and hence variable cost should be 80. Right? You can just do cross multiplication with this. You will be getting selling price. 69 into 100 divided by 80. 86.25. So my contribution will be not required, but still I am finding out 86.25 minus 69, which is 17.25. And believe me, my PV ratio will remain 20%. You may even verify it. 17.25 divided by 86.25 multiplied by 100 is how much? 20%. Now, sir, fixed cost is increasing. Will we not have to increase our selling price? No. What we want to maintain, we don't want to maintain same profit. We want to maintain same PV ratio. And PV ratio is not affected by fixed cost. Whether your fixed cost is increasing or decreasing, your PV ratio is not affected. PV ratio is affected by your selling price and your variable cost. It is not affected by fixed cost. A very simple and good question. 14.7. This all calculation probably was not required. Still I have done it. It is all right. So it is a good thing to know. We should always read question first. Full question first. So from this question we'll try that. 14.8. When the volume is 4,000 units, average cost is 3.75 per unit. When the volume is 5,000 unit, average cost is 3.50. The break-even point is 6,000 units. Calculate variable cost, fixed cost, PV ratio. Let me write it down. If the units are 4,000, average cost is 3.75, and so total cost will be 4,000 into 3.75. 15,000 rupees. 15. This will be total, this will be per unit. But if my volume is 5,000 units, my average cost is 3.50, and so my total cost will be 5,000 into 17,500. Find out variable cost per unit. There are two situations available. I can easily find out variable cost per unit by a formula. Today we have not revised it, but still we know it. Variable cost per unit is nothing but change in cost divided by change in units. Now, sir, we need to do everything by formula. Yes, we have understood the formula. We have not just mug up the formula. We know that this difference in cost is because of variable cost, because difference in cost is never because of fixed cost. So difference in cost will be variable cost divided by number of units is variable cost per unit. This will be 2,500 divided by changes in units is 1,000 will be 2.5 rupees per unit. This is answer number 1 of variable cost. Fixed cost. Break even point is given. Selling price is all right. At 4,000 units, I can find out yes, I can find out fixed cost at 4,000 units, right? At 4,000 units, variable cost will be 4,000 into 2.5. That is 10,000 rupees. Total cost is 15,000 rupees. So fixed cost will be total cost minus variable cost. 15,000 minus 10,000 will be nothing but rupees 5,000 rupees is what? Fixed cost. Break even point is the 6,000 units. Find out the PV ratio. Break even point in units is equal to 6,000. So can I say 6,000 is equal to fixed cost upon contribution per unit? So fixed cost I am knowing. Contribution per unit will be is equal to fixed cost. Fixed cost is 5,000 divided by 6,000 will be contribution per 0.8333. Selling price minus variable cost is nothing but contribution per unit. This is 0.8333. Variable cost I am knowing. It is 2.5. So my selling price should be 0.8 plus 2.5. It is 3. From this, I can easily find out PV ratio, which will be contribution divided by sales into.
Now understand, you could have found out this answer by some other method, by some other way. Till the time answer is same, it is absolutely correct method.
0.8333 divided by multiplied by 100. It is 24.9999 is 25%, which is nothing but PV ratio. All three questions are solved. We can go ahead. Next question is 14.9. Now, this is just a problem solving. You just need to write down the information and try to solve whatever is asked in the question. MS Gaurav Private Limited is manufacturing and selling two products, black and white, at a selling price of 20 and 30 respectively. So black is 20 and white is 30. The following sales strategy has been outlined for the financial year 1920. Sales planned for the year will be 81 lakhs in the case of black and 54 lakhs in the case of white. The selling price of the black will be reduced by 10% and the white by 20%. Break even is planned at 70% of total sales of each product. Profit for the year to be maintained at 8,26,200 in the case of black and 7,45,200 in case of white. This would be possible by reducing the present annual fixed cost of 42 lakhs, allocated 22 lakhs to black and 20 lakhs to white. You are required to calculate number of units to be sold of black and white to break even during the year financial year 1920. So it is in current year. Amount of reduction in fixed cost product wise to achieve desired profit mentioned in 4 above. So this is second question. First we need to find out number of units to be sold by black and white to break even during the financial year 1920. Black and white, I am doing it in column wise. Black, white. Selling price of black and white will be 20 and 30. Selling price per unit will be 20 and 30, which will be reduced. The selling price of black will be reduced by 10% and white will be reduced by 20%. So selling price will be reduced by 10%. Selling price per unit new will become 18 and this will be 20%. So this will be 24. Sales planned for the year will be 81 lakh in case of black and 54 lakhs in case of white. So sales is 81 lakh rupees and 54 lakhs rupees. So what will be sales units? Sales in units will be 81 lakh divided by 18. 81 lakh divided by 18 is 4,50,000 units. And this will be 54 lakh divided by 24. 2,25,000. These are in units, right? This is our plan. What is our plan in the year 1920? This is year 1920. I will be in the year 1920, I will be doing a sales of 81 lakhs at a selling price of 18 per unit. So I will be totally selling 4,50,000 units. The 54 lakhs rupees, so I will be selling 2,25,000 units. Now they have given break even is planned at 70% of total sales of each product. So what will be break even point? I can find out in units as well as rupees. Break even point in units will be 70% of these figures. 4,50,000 multiplied by 0.7, 3,15,000. So they will structure their variable cost and fixed cost in such a manner that 70% of sales will be break even point and 2,25,000 into 70%. One lakh 57,500. They have not told me in units. I need to find out in units or rupees. No, it is given. Number of units to be sold by black and white to break even during the financial year 1920. I will not find out answer in rupees. It is specifically given number of units. I can end the answer over here. Answer number 1. 3,15,000 units of black should be sold to break even and 1,57,500 should be sold to break even. Now this is an interesting question. Fourth and second are related. Profit for the year end to be maintained at 8,26,200 in the case of black. So let me have another chart. Black, white. What is profit required for black? Is 8,26,200. What is profit required for white? 745 200. In case of Y, this would be possible by reducing the present annual fixed cost, which is 42 lakhs allocated as 22 lakhs and 20 lakhs. All right. So we will reduce the fixed cost. Whatever changes we'll be making it in fixed cost. All right. So let me do my planning. Planning is I will be doing the sales, which was planned. What was planned? 81 lakh and 54 lakhs. Minus variable cost. Now I'll have to find out my variable cost from here. I can find out. I am having break-even point in units. Break-even point in units multiplied by contribution per unit is fixed cost. So can I write down contribution per unit? Contribution per unit will be is equal to fixed cost upon break-even point in units, right? I'm just changing the side. Break-even point in units is fixed cost divided by contribution per unit. So contribution per unit is fixed cost divided by break-even point in units. Fixed cost I am knowing for black, yes. Right now it is 22 lakhs and 20 lakhs. So let me write down fixed cost even over here. What is fixed cost? 22 lakhs rupees. 20 lakhs rupees. I can easily find out contribution per unit. Contribution per unit will be fixed cost divided by break-even point in units. 22 lakhs divided by 3,15,000. 6.9841. This will be 20 lakhs divided by 157,500. $12.6984. $12.6984. I have got contribution per unit. I am having selling price per unit. I can easily find out variable cost per unit. So variable cost per unit will be selling price minus contribution, which will be 18 minus 6.9841, 11.0159. And here variable cost will be 24 minus 12.6984, 11.3016. I have got answer of variable cost per unit, which I can use over here. How many units of black units sold of black are there? I know it is 4,50,000. And white I am selling 2,25,000. So I can find out variable cost. It is 4,50,000 into 4,50,000 into variable cost and 2,25,000 into variable cost. Variable cost is in decimal, so 11.0159. And white will be 11.3016. My variable cost will be 4,50,000 into 11.0159 is equal to 49,57,155. And variable cost of this will be 2,25,000 multiplied by 11.3016, 25,42,860. What is the answer of contribution? It is 81 lakhs minus 49,57,155, 31 lakh 42,845, 31,42,845. And this will be 54 lakhs minus 25,42,860, 28,57,140. Margin of safety will be 30% of sales. Yes, you are right. It will be 30% of the sales. So 81 lakhs into 30%. Will be 24,30,000. $24,30,000 margin of sales. It is margin of safety 20% of 30% of sales will be, and in second case also it is same, right? 30% of sales will be margin of safety. 16,20,000. We know we can find out margin profit volume ratio by, we know margin of safety in rupees multiplied by PV ratio should be is equal to profit. We know this formula. Margin of safety in rupees multiplied by PV ratio should be profit. So margin of safety in rupees and profit we are knowing. So PV ratio will be profit divided by margin of safety. That will be 826,200 divided by 24,30,000. It is 0.34. That is 34%. And this will be this divided by this. 745,200 divided by 16,20,000. It is 0.46. Now it is very easy to solve. My sales is this, my PV ratio will be this, my sales is this, my PV ratio will be this. So I will be getting answer of contribution. Contribution will be sales multiplied by PV ratio. Black, white. Sales is 81 lakh into 34%. It is 27,54,000. 27,54,000. And this is 54 lakh into 46%. It is 24,84,000. Minus a fixed cost should be my answer of profit, but answer of profit is given. I'll be getting answer of fixed cost. Profit should be 826,200 and 745,200. So my fixed cost will be difference of this two. 2754 minus 826,200. 19,27,800. And this would be 20, excuse me, 24,84,000 minus 745,200. 17,38,800. This should be your fixed cost to get this desired profit. How much fixed cost you should reduce so that your desired profit is this? This was 22 lakhs. It should be reduced to 19,27,800. This was, yes, 22 lakhs. This was 20 lakhs. It should be reduced to 17,38,800. Believe me, I am having some provisions regarding this particular question. This question is not drafted correctly. Why, I'll tell you. If black PV ratio for this desired profit is 34%. PV ratio is decided by selling price and variable cost. To get this desired profit, you are not changing anything except your fixed cost. To get this desired profit, you are not changing your selling price per unit. You are not changing your variable cost per unit. They are remaining same. So PV ratio should remain same. So in this, when we were not talking about desired profit, black PV ratio should be 34%. If black PV ratio is 34%, fixed cost is given. 22 lakh divided by PV ratio should be break-even point in rupees. 22 lakh divided by 34%. 22 divided by 34% should be break-even point in rupees. 64,70,588. 64,70,588 rupees. Divided by 80 should be break-even point in units. So 64,70,588 divided by 18. What should be answer? 3,59,477. Should be break-even point in unit. What is break-even point in units given? 3,15,000. So as per the information given, only your answers are not matching, right? So the question is drafted incorrectly. What is the best idea? Don't revise this going to examination. Right? Don't revise it at all. The conceptual idea will change. Sir, if the same question is asked again, there are 99% chances that it will not asked again. If it is asked again, you should solve by this method. That's all right. Just remember it right now. Never revise this because it is weird. Actually, this answer, the answers which we were in process of finding, and this answer should come same, but it will not come same because it is not drafted correctly. PV ratio originally is not 34%, and one fine day it is becoming 34%, right? So this is weird question number 14.9. We are going to 14.10. PJ Limited manufactures hockey sticks. It sells the products at rupees 500 each. and makes a profit of rupees 125 on each stick. The company is producing 5,000 sticks annually by using 50% of its machinery capacity. So total machinery capacity might be to produce 10,000 sticks. The cost of stick is as under: 150 direct wages, 50 work overhead, 50% fixed, 50% variable, selling expense 50, 25 variable. The anticipation for the next year is that the cost will go up as under. So there is an increase in cost. There will be not a change in selling price. There is an additional order of 2,000 sticks in next year. Calculate the lowest price that can be quoted so that the company can earn the same profit as it earned in current year. So I will have to find out current year's figure. I am first doing everything of current year. Number of units sold is 5,000 sticks. Number of sticks sold, 5,000 sticks. Selling price per stick 500. Selling price per stick 500 minus variable cost per stick, minus variable cost per stick. Direct material and direct wages are always variable. Direct material 150, direct wages 50, overhead variable is only 50%, so 125 into 50%. 125 divided by 2, that is 62.5. And selling expense 25% variable, so 25% of 50 rupees, it is 12.5. Here we need to consider each and every cost. We will be considering even selling cost. Each and every cost is important. We just need to decide whether it is fixed or variable. This will be my variable cost per unit. 500. Sorry. 150 plus 50 plus 62.5 plus 12.5. It is 275. Is my variable cost per unit at 5,000 stick level minus fixed cost. Fixed cost is 50% of this, that is 62.5 right now per unit, and 75% of this, that is 50 minus 12.5 is 37.5. So right now fixed cost per unit is 100, and so profit should be 375 minus 500 should be 125, and this is given in the question. Right now it is earning 125 rupees of profit on each stick. All right. What is contribution per unit right now? 125 per stick. So 125 into 5,000, I can find out total profit. $6,25,000. And my fixed cost right now is 5,000 into 100. So fixed cost is 5 lakhs. I will not be requiring other figures like sales, variable cost. Total selling price is required per unit and variable cost per unit is required. So what is given in the question? Fixed charge will increase by 10%. So what is my fixed charge of 5 lakhs? In next year it will become 5 lakh 50,000. Direct wages will increase by 20%. So direct wages of 50 and 20% will become 60 rupees. Direct material will increase by 5%. So direct material 5% is 157.5. This is going to remain 62.5 and selling expenses is going to remain 12.5. So my new variable cost will be 157.5 plus 60 plus 62.5 plus 12.5. It is 292 point. Is my new variable cost. Now let me write down all the figures. My selling price is going to remain 500 per unit. Variable cost per unit is 292.5. And my revised fixed cost, this is also per unit, and the revised fixed cost in total is 5,50,000. And now let us try to understand the question what they want to ask us. There is an additional order of 2 lakh sticks in next year. So currently you are selling 5,000 sticks at 500 rupees and that selling price is not going to change. There is an additional order of 2,000 sticks in next year. Calculate the lowest price that can be quoted for this 2,000 sticks, so that the company can earn the same profit it has earned in current year. What profit it has earned in current year? 6,25,000. I want to earn the same profit. Can I say sales minus variable cost minus fixed cost is equal to profit? Sales will be 5,000 into 500 for that 5,000 goods plus 2,000 into this rate I need to find out. So I am writing down X minus variable cost will be 7. Now I'll have to manufacture 7,000 units at 292.5 minus 5,50,000. I want a profit of 6,25,000, which I have earned in previous year. This will be, I am drafting the equation, will be 25 lakhs plus 2,000x minus, this will be 20,47,500 minus 5,50,000 will be 6,25,000. So here X will be 6,25,000 plus 5,50,000 plus 20,47,500 minus 25 lakhs divided by 2,000. 361.25. Please concentrate what is 361.25. You are selling 5,000 units at the rate of rupees 500. If you sell additional 2,000 units at 361.25, then in current year you will be earning profit of 6,25,000 rupees. This is what is asked. You will tell me, sir, last year we were earning 6,25,000 by selling 5,000 units. In current year we are earning 6,25,000 rupees profit by selling 7,000 units. You are absolutely correct. But this is what is asked in the question. Next one. Next one is very nice, very intelligent question. During the particular period, ABC has furnished the following data. Sales is 10 lakhs. Contribution to sales ratio is 37%. Margin of safety is 25% on sales. A decrease in selling price and decrease in fixed cost could change the contribution to sales ratio to 30% and margin of safety to 40% of revised sales. Calculate revised fixed cost, revised sales and new break-even point. Try to concentrate. What is my current contribution to sales ratio? Contribution to sales ratio is 37%, which is nothing but PV ratio. If my sales is 100, if I'm not saying selling price per unit is 100, if selling price per unit is 100, my variable cost will be 63, and so my contribution will be 37, and in this case my PV ratio will be 37%. What is proposed? My PV ratio will become 30% because my fixed cost and selling price. Fixed cost does not affect my PV ratio. What affects my PV ratio? Only two things. Selling price per unit, if you increase or decrease. Variable cost per unit, if you increase or decrease. Here what you are decreasing so that it is becoming 30%, you are decreasing your selling price. Please understand, if you decrease your selling price per unit, your variable cost is not going to change. Per unit variable cost remains same. If you decrease your selling price, your per unit variable cost remains same. How? Understand in form of Pani Puri. My selling price is 10, variable cost is 4. So contribution is 6, and so PV ratio is 60%. If I decrease my selling price to 8, my variable cost is still going to remain 4 per dish, Pani Puri dish. At what rate I was manufacturing Pani Puri dish before? 4. Selling at 10. Now I am just selling at 8. The manufacturing cost is going to remain 4 and contribution will remain 4. PV ratio will change to 50%. Why my PV ratio is decreasing? Just because selling price has reduced by 20%. I want the selling price reduction so that this answer should be 30%. Please understand, if this is 100%, this is 70%, then this will be 30%. Right? So just cross multiply this, you will be getting answer. 63 multiplied by 100 divided by 70. It is 90 rupees. This will be 27. Sir, my new selling price per unit is 90. No, this 100 we have assumed. Then what I will use? Understand. My selling price is decreased by 10%. So that my PV ratio is converted from 37% to 30%. Try to understand, this is also in percentage, this is also in percentage. Nominal values are not important. So this values, if you assume anything, it is absolutely all right. Your answer is going to remain same. If I reduce my selling price by 10%, my PV ratio from 37% will become 30%. So new PV ratio is 30% and selling price has decreased by 10%. What was my sales before? My sales before was 10 lakhs. Now the selling price has reduced by 10%. So my new sales will be 9 lakhs. Everything else will remain same. Variable cost is going to remain same. Yes. Contribution will be 9 lakhs into 30% only. Right? But contribution is not asked. They are saying then my margin of safety will be 40% of revised sales. So MOS in rupees will be 9 lakh into 40%, will be 3 lakh 60,000. So what will be my break even point sales? 9 lakh minus 3 lakh 60,000. 9 lakh minus 3 lakh 60,000 is 5 lakh 40,000 rupees. Also, can I say break even point in rupees is a fixed cost upon PV ratio? What is break even point in rupees? 5 lakh 40,000. Fixed cost, I don't know. I need to find out new fixed cost divided by 30%. So 5 lakh 40,000 into 30%. 1 lakh 62,000. Revised fixed cost will be rupees 1 lakh 60,000. And this is what is asked. What will be your new fixed cost? What will be your new break even point? Revised fixed cost, revised sales, and revised break even point. Revised sales is 9 lakhs, revised break even point is 5 lakh 40,000, and revised fixed cost is 1 lakh 62,000.
So in this lecture, first we are going to revise the PV ratio. In a previous session, we got some questions of PV ratio, and I think it is very much important point to exactly understand the concept of PV ratio. What is PV ratio? It shows the relationship between your contribution and sales. So it is practically contribution divided by sales multiplied by 100. If it is 0.20 or 20%, what does it mean? Your contribution is 20% of your sales. That also means your variable cost is 80% of your sales. Variable cost 80% of sales and your contribution 20% of sales. This is what does it mean. There are various methods of finding it out. PV ratio can be total contribution divided by total sales into 100. It can be change in contribution divided by change in sales into 100. It can be contribution per unit divided by selling price per unit multiplied by 100. It can also be, most important, change in profit divided by change in sales multiplied by 100, because change in contribution and change in profit will always be same, fixed cost being equal. This is PV ratio. Now understand, we took our basic example of Pani Puri, right? If my selling price is rupees 10, my variable cost is rupees 4, my contribution per unit will be rupees 6, which will be PV ratio of 60%. How? 6 divided by 10 multiplied by 100 will be 60%. Now, if someone says me that I am increasing the selling price to 12 rupees, see, variable cost is dependent upon total sales. Variable cost is not dependent upon selling price per unit. If your number of unit increases, your total variable cost will increase. But if selling price increases, total variable cost per unit variable cost still remains same. You have increased your selling price. Your price of potatoes, price of pani, price of chana has remained constant. Your PV ratio will change, and it will change to 8 divided by 12 multiplied by 100, which will be it is 8 divided by 12. It is 66.67. See, I am increasing my selling price, my contribution ratio, my PV ratio is changing. If I change my variable cost, say from this situation, my selling price is 10, but my variable cost has increased. Why it has increased? The price of puri has increased, the price of chana has increased, the price of water has increased. My variable cost has become 5. My contribution will be 5. See, my PV ratio will be 50%. if there is a change in variable cost per unit, if there is a change in selling price per unit, my contribution ratio, that is PV ratio, will change. If I say in this question my fixed cost was 10,000, my PV ratio is 60%. In this point my fixed cost was say 20,000, my PV ratio will still remain 50%. PV ratio is not dependent upon fixed cost. Number one, PV ratio is not dependent upon unit sold. Unit sold will increase your total contribution. Yes, if unit sales increases, my total contribution will increase, but my total sales will also increase and PV ratio will remain same. So when PV ratio changes, when either selling price you increase or decrease, or variable cost you increase or decrease, then only your PV ratio changes. Otherwise your PV ratio remains same. Let us continue with some of the questions of marginal costing. 14.12. Two manufacturing companies A and B are planning to merge. The details are as follows. So these companies are planning to merge. Capacity utilization is 90% and 60%. So company A is working at 90% of its capacity. Sales is 63 lakhs, variable cost is 39 lakhs 60,000 and fixed cost is 13 lakhs, and all information of B company is also given. Assume that the proposal is implemented. What does it mean? Assume that merger happens. Find out break-even sales of merged plant, capacity utilization at that stage. Profitability of merged plant at 80% capacity utilization. Sales turnover of the merged plant to earn a profit of 60 lakhs. When the merged plant is working at a capacity to earn profit of 60 lakhs, what percentage of increasing selling price is required to sustain an increase of 5% on fixed overhead? First, try to concentrate. There is a company A which is working at 90% capacity. There is company B which is working at 60% capacity. If this both company merges, I will be writing total, that is A plus B, or merged entity. Now, at 90% capacity, what is the sales of A? Sales of A is 63 lakhs. So sales at 93% is 63 lakhs. What will be sales at 100%? What will be sales at 100%? If at 90% it is 63 lakhs, at 100% it will be 70 lakhs. Right? Simple mathematics. At 90% it is 63. So 100% how much? Cross multiplication. 100 into 63 divided by 90. Will be 70 lakhs. Similarly, B at 60% is selling 48 lakhs. What it will be selling at 100%? It is 48 into 100 divided by 60. 48 lakhs into 100 divided by 60. It is 80 lakhs. Please concentrate. If this both company merge, A Limited will now not be working at 90% capacity and B Limited will now not be working at 60% capacity. They both will be working at 100% capacity. Or if I say, if they both merges and both are working at 100% capacity, what will be sales? 80 plus 70, that is
1 crore 50 lakhs.
This is merged entity total capacity. This is merged entity total capacity.
Now, what was variable cost at 90% minus variable cost of company A? 39 lakh 60,000. What was variable cost of B? 22 lakh 50,000.
Now, if company A was working at 100% capacity, what would be its variable cost? Just a cross multiplication. If 63 lakh sales is having 39 lakh 60,000 variable cost, 70 lakh sales will be having how much variable cost?
Will be 39 lakh 60,000 divided by 63 lakhs multiplied by 70 lakhs, which is 44 lakhs. If your sales increases, if you are now working at 100% capacity, your total variable cost will increase. Sir, my per unit variable cost remains same. Per unit variable cost still remains same, but my total variable cost will increase. Similarly, here also cross multiplication. What will be variable cost if I am working at 100% capacity? That is 22 lakh 50,000 multiplied by 80 lakhs divided by 48 lakhs, which is 37 lakh 50,000.
What will be my variable cost if both entity merge? If both entity merge, we are assuming both are working at 100% capacity, then 44 lakhs plus 37 lakh 50,000 will be
44 plus 37.5 is 81 lakh 50,000.
Will be nothing but variable cost of combined merge plant if they are working at
100% capacity. There is a fixed cost? Yes. 13 lakh, 15 lakh minus fixed cost. 13 lakh, 15 lakh.
13 lakh is at 90% capacity. What will be at 100% capacity? Cross multiplication. No. Now, at 90% capacity also fixed cost in company A was 13 lakhs. At 100% capacity also it will be 13 lakhs. At 60% capacity the fixed cost was 15 lakhs. At 100% capacity also fixed cost remained 15 lakhs. Fixed cost in total remains the same. 13 plus 15, 28 lakhs will be nothing but fixed cost of merged entity. I am now talking only about merged entity. At 100% capacity. What will be sales? 150 lakhs minus variable cost 81 lakh 50,000. So my contribution would be 150 lakhs minus 81 lakh 50,000, that is 68 lakh 50,000. What will be my PV ratio of merge plant? It is 68 lakh 50,000 divided by 150 lakhs multiplied by 100. 68 lakh 50,000 divided by 150 lakhs multiplied by 100.
68 lakh 50,000 divided by 150 lakhs multiplied by 100. It is 45.67 percentage. It is contribution margin ratio or PV ratio with a fixed cost of 28 lakhs. So fixed cost of merged entity will be 28 lakhs rupees. Let us see now what they ask us in question. Break-even sales of merged plant and capacity utilization at that stage. First I am finding out break-even sales of merged plant. 1. Break-even point in rupees is a fixed cost upon PV ratio. Whose fixed cost I will be taking? Merged plant. Whose PV ratio I will be taking? Merged plant. Fixed cost is 28 lakhs. PV ratio is 45.67 percentage. Will be is equal to rupees. The answer will be in rupees. 28 lakhs divided by 45.67 percentage. It is 61 lakh 30,939. 61,30,940. What is this? Break even sales or break even point in rupees. They are also asking me, and the capacity utilization at that stage. What they are saying, if you are working at break even point, so they are asking me if my sales is 61 lakh 30,940, how much capacity utilization I am having? Very simple. If I am working at 150 lakhs, that is 1 crore 50 lakhs, I am working at 100% capacity utilization. If I sell 150 lakhs, I am working at 100% capacity utilization. At 61 lakh 30,940, what will be my capacity utilization? Cross multiplication, 61 lakh 30,940 divided by 150 lakhs. It is 40.87 percentage. So, if my merge plan is working at 40.87 percentage, I will be breaking even. So, if my merge plant is working at 50% capacity, I will be earning profits. Working at 80% capacity, I will be earning profits. If my merge plant is working at 40% capacity, I will be incurring losses. At 40.87, my merge plant will be break even. What is second question? Profitability of merge plant at 80% capacity utilization. Answer number 2. At 80% capacity utilization, my sales will be 150 lakhs multiplied by 80%. That is 120 lakhs. What will be my contribution? 1 crore 20 lakhs multiplied by 45.67 percentage. This means 45.67% means if my sales is 100, contribution is 45.67 and remaining is my variable cost. So what will be my contribution at 80% capacity utilization will be 120 lakhs into 0.4567. It is 54 lakh 80,400. 54 lakh 80,400. From contribution, I just need to deduct fixed cost. And what is my fixed cost? Is 28 lakhs of merge plant. We are right now talking only about merge plant. This will be my profit. 54 lakh 80,000 minus 28 lakhs. 26 lakh 80,000. $26 lakh 80,400 will be my profit. If the merge plant is totally working at 80% capacity, I will be earning a profit of rupees 26 lakh 80,400. Next question. Sales turnover of merge plant to earn a profit of 60 lakhs. So this can be done by n numbers of ways. I normally do it by way which I feel is very much comfortable. What is profit required? Is 60 lakhs. My fixed cost is going to remain 28 lakhs. This is profit. What contribution will be required to earn a profit of 60 lakhs? Is 88 lakhs? Do you understand this? I have written it in a form of an equation. 88 lakhs rupees is nothing but required contribution. What sales I should be doing to have profit of 60 lakhs or contribution of 88 lakhs? Sales is X. Contribution is 45.67% multiplied by total contribution 88 lakhs. 88 lakhs divided by 45.67%. Divided by, it is 1 crore 92 lakh 68,666. 192,68,666. This must be the sales to earn a profit of 60 lakhs. Sir, we have learned a formula for desired profit. Yes, you can use that formula easily over here. What was the sales in rupees for desired profit? It is a fixed cost plus desired profit upon PV ratio. This is the same thing which I have done. 28 lakhs plus 60 lakhs upon 45.67% is 192,68,666. Actually, you should do by this method only. Good. Try to concentrate. What is my fixed cost right now? 28 lakhs. How much increase in fixed cost I want? 5%. That is 1,40,000 rupees. My fixed cost will increase. Everything else is remaining same. So if my fixed cost increase, my profit will decrease by 1,40,000. If my fixed cost increases, my profit will decrease by 1,40,000. So I don't want to decrease my profit. What is my profit right now is 60 lakhs. So I want to keep it 60 lakhs. Now try to concentrate. If I want to keep my profit as 60 lakhs, And if my fixed cost is increasing by 1,40,000, then I will have to increase my contribution by 1,40,000. Then only that contribution will compensate my increase in fixed cost and my profit will be 60 lakhs. Say my contribution right now is 10 lakhs. My fixed cost is say, my contribution is say 100 lakhs. And my fixed cost is 40 lakhs. And my profit is 60 lakhs. So if I increase 1,40,000 over here, I will have to increase 1,40,000 contribution. Right? So to keep profit as it is, if my fixed cost increases by 1,40,000, my contribution should increase by 1,40,000. My variable cost is remaining same. So I will have to increase my sales by 1,40,000 rupees. A very easy point, we have just complicated it, but if my profit is going to remain same and my fixed cost is going to increase by 1,40,000, I will have to increase my contribution by 1,40,000. My variable cost remaining same, I will have to increase my sales by 1,40,000. So increase in sales required is 1,40,000 rupees. Now, the problem is I am not increasing my unit sold. So I will have to increase it through selling price. But what was my total sales before this? My total sales was 192,68,666. 192,68,666 rupees multiplied by 100. This much should be increase in sales, and increase in sales will happen because of increase in selling price. Increase in sales happens in two ways. Number one, if you increase the number of units sold, and number two, if you increase the selling price. Ultimately, I want a total increase of 1,40,000 from 1,92,68,667. The percentage increase required will be 140 divided by 192,68,666 multiplied by 100. It is 0.73% approximately. See, what does this mean? It is very simple. If my fixed cost is increasing by 1,40,000, if I increase my selling price by 0.73%, my sales will increase by 1,40,000. Variable cost being same, my contribution will increase by 1,40,000, will compensate the increase in fixed cost of 1,40,000, and so I will be earning same amount of profit. Mark it as a good point. Fourth point is an excellent point. We are going to 14.13. The following figures available for the records of ABC company as at 31st March. Year 1, year 2, sales is given and profit is given. Calculate PV ratio. PV ratio, now you will have to search the formulas. How to find out PV ratio from given data? Change in profit upon change in sales multiplied by 100. This is one of the formula for PV ratio. And we know it is change in contribution divided by change in sales. But change in contribution and change in profit will always be same, fixed cost being same. Change in profit is from 30 to 45 is 15 lakhs. Change in sales is 50 lakhs. Multiplied by 100, I will be getting answer of PV ratio. $15 divided by 50 multiplied by 30%. It is 30% is PV ratio. They are telling me to find out PV ratio and total fixed expenditure. You can take any of the point. You can take year 1 and find out fixed cost, because fixed cost in year 1 and year 2 will remain same. Year 1, my sales is 200. So my contribution will be 200 into 30% will be 60 lakhs. Minus a fixed cost should be profit. Profit is given as 30 lakhs, and so my fixed cost should be 30 lakhs. So fixed cost will be 30 lakhs. Sir, we need to verify it in year 2. No. If they are just telling me to find out fixed expenditure, that is fixed cost, you can just find out fixed cost by year 2 or by year 1. Break-even level of sales for this company, not year 1 and year 2. Whether year 1 or year 2, this company is having fixed cost of 30 lakhs and PV ratio of 30%. Then break-even point in rupees will be fixed cost upon PV ratio, which is 30 lakhs divided by 30% will be 100 lakhs rupees. This will be break-even point in rupees for this company. Sales required to earn a profit of 70 lakhs. Sales to earn profit of rupees 70 lakhs. Sales for desired profit in rupees is a fixed cost plus desired profit upon PV ratio. Fixed cost is 30 lakhs, desired profit is 70 lakhs divided by 30%. This is 100 lakhs divided by 30%. 100 divided by 30% is 333 lakhs. That is 3 crore 33 lakh 33,333. A simple question asked n numbers of times. No important point. If you just read and solve it, it is absolutely alright. But yes, good point was this. PV ratio is found out by that fourth or new formula. Change in profit divided by change in sales multiplied by 100. Alright. We are going to, when there are more than one product, how to find out break-even point. Try to concentrate with this basic question. I'll be explaining you the concept how to solve break-even point when there are multiple products. A company sells two products J and K. The sales mix is 4 units of J and 3 units of K. The contribution margin are 40 for J and 20 for K. Fixed cost is 6,16,000 per month. Compute the break-even point. Try to concentrate. There are two products J and K. Both are having contribution per unit of 40 and 20 respectively. The fixed cost is for J or K, it is for the company which is manufacturing both the products J and K. And what is the fixed cost is 6,16,000. Sir, it is of J or K, it is for both. It is of company. Sir, in this scenario, how to find out break-even point? I will tell you how to find out break-even point. Please try to understand there are two products manufactured. Let us make this two product into one product. Try to concentrate. Instead of J individual and K individual, I am manufacturing another product. Try to concentrate. which is nothing but a box. A box will contain 4 units of J and 3 units of K. 4 units of J and 3 units of K. Always. How I sell my goods? I sell my goods not J, not K, but I sell my goods of a box, in a box. And a box contains 4J and 3K, always. So what is sold in the market? A box. You have seen, right? In pencil, rubber, scale. If you go to a stationery, there is a box available in which a pencil will be also there, a sharpener will be also there, a rubber will be also there, and a scale will be also there. So let us make that type of box. A box will always contain 4J and 3K. So this box will be giving me how much contribution? This box will be giving me 4 4s are 16, 160 rupees, and 3K will be multiplied by 20. J per unit is giving 40 and K per unit is giving me 20. So this will be 120. And so total contribution of the box is 280 rupees. Once again, 280 rupees is contribution of J? No. Is it contribution of K? No. It is contribution of a box in which there are 4J and 3K. 4J and 3K. So 280 rupees is contribution for 1J, 3J, 4J, nothing to write down. For one.
Sir,
Yes. Contribution of K is the 60, not 120. Yes. And so total will be 220. So 220 will be contribution of one box will be giving you contribution of 220 rupees. Now, try to understand, I am finding out break even point for J, no. For K, no. For a box. How to find out break even point in boxes? It is a fixed cost divided by contribution per unit, no, per box. Contribution fixed cost divided by contribution per box. It is 6,16,000 divided by 200 and how many boxes? 6,16,000 divided by 220, which is 2,800 boxes. If this company sells 2,800 boxes, it will break even. One box contains 4J and 3K. So, if they are selling 2,800 boxes, they are selling how many J? 2,800 into 4. J? That is 11,200 J, and 2,800 into 3 will be K. 2,800 into 3 will be 8,000. Total, never do it. You cannot make a total of commodity of J and K, right? What is my break even point? 2,800 boxes, but box we have prepared it for our ease of calculation. So what is break even point is 11,200 of J and 8,400 of K will be my break even point. I always sell in the ratio of 4:3. So this ratio will be also in the ratio of 4:3. Whenever there are multiple products, always do this. Rather than going product wise, prepare a box and the mix will be given. Prepare a box
find out contribution per box, find out a break even point in box, and then understand if break even point in boxes is 2800 boxes, how many of J and K should be sold to get a break even. A good point. This was asked for 5 marks, and from that year November 2009 they have asked n numbers of times this type of questions which is having multiple products. We are going to another 14.15. A company is producing an identical product in 2 factories. So they are identical products. So same products are manufactured in factory X also, factory Y also. And details in the respect of both factories are given. Selling price per unit is 50. It should be 50. Why? It is manufacturing same product. Variable cost in factory X is higher. Fixed cost in factory Y is higher. Depreciation included in above fixed cost is 40,000, 30,000. Sales in units 30,000, 20,000. Production capacity 40,000, 30,000. Compute break even point of each factory individually. So I am taking each factory individually X and Y. What will be contribution per unit of X will be selling price minus variable cost is 10. Selling price minus variable cost will be 15. What is the fixed cost of factory X is 2 lakhs rupees. And for factory Y is 3 lakhs rupees. What will be break even point? Break even point is a fixed cost upon contribution per unit. That is the 2 lakh divided by 10, which will be 20,000 units. And this will be 3 lakh divided by 50, which will be 20,000. So sir, in both the factories my break even point is same? Yes. Why it is same? One is having higher fixed cost, one is having higher variable cost. This is my answer number 1. Number 2, find out cash break even point for each factory individually. What is cash break even point is, instead of taking whole of your fixed cost, I take only my cash fixed cost. Now what is my total fixed cost? 2 lakhs. Out of which how much is depreciation? 40,000. So what will be my fixed cost except depreciation? Fixed cost excluding depreciation will be 1,60,000. How 1,60,000? 2 lakh minus 40,000. And here it will be 3 lakh minus 30,000, which will be 2,70,000. My contribution per unit remains same. As I told you, fixed cost does not affect my contribution per unit or PV ratio. My cash break even point will be fixed cost excluding depreciation upon contribution per unit. It is 1,60,000 divided by 10 is 16,000 units, and 2,70,000 divided by 15, 18,000. So a new concept, cash break even point, not a difficult one. In cash break even point, instead of taking fixed cost, I will be taking only cash fixed cost. Break even point for a company as a whole, assuming that the present production mix is in the sales ratio. What is the sales in unit? 30,000 and 20,000. So we are going to assume that our sales mix is in ratio always of 3:2. My sales mix
will be in the ratio of 3:2, where 3 is a product manufactured from factory X and 2 is a product manufactured from factory Y. What will be total fixed cost for both the factories? 2 lakh plus 3 lakhs, that is 5 lakhs. All right. Concept of box. There are two. Their product is same, but they are manufactured in different factory. So my box will contain 3 units of X and 2 units of Y. What contribution box will generate? 3 multiplied by contribution of X is a 10 plus 2 multiplied by contribution of Y is 50. So 30 plus 30 is equal to 60 rupees. What is 60 rupees contribution of X, Y? It is contribution of a box. What does box contains? 3 units manufactured by X and 2 units manufactured by Y. See what I am finding out. I am finding out break-even point not in rupees, not in units, but in boxes. How many boxes will be break-even point? Will be 5 lakh rupees divided by contribution per box, which is 60. How I have found out? Fixed cost upon contribution per box. This is 8,333 boxes. Will be my break-even point in boxes. 8,333.33 boxes is equal to how many X and how many Y? X are 3 multiplied by 3 multiplied by 2. This will be X, this will be Y. So X will be 8,333.33 multiplied by 3, which is 24,999, that is 25,000. Units of X and 8,333.33 multiplied by 2, that is 16,667. What is my break-even point? 8,333.33 boxes, which will contain 25,000 units of X and 16,667 units of Y. Are you getting it? Sir, can I prepare this boxes and can I write down my answer in examination as it is? The answer is yes. All working notes should form part of your answer. This is a valid presentation. You can prepare a box, write down it is containing 3x and 2y, and you can find out contribution per box. You can find out break-even point in boxes, and then, but yes, you'll have to write down final this answer. You cannot write down only 8,333.33 boxes. All right. Consequences on profit and break-even point. If product mix is changed to 2:3, total demand remaining same. What is total demand right now? 50,000. 30,000 and 20,000. So total demand is 50,000 units. What they are saying is, if I change my sales ratio from 3:2 to 2:3, so X2 20,000 units and Y I sell 30,000 units. Then what will be my new profit? Try to understand. What is contribution? What X is earning multiplied by 10, multiplied by 15. Total contribution will be 2 lakhs. Your total contribution will be 4,50,000 minus fixed cost. Fixed cost of X is 2 lakhs. And the fixed cost of Y is 3 lakhs. This will be 1,50,000. This will be 0. What will be my total profit? 1,50,000 rupees. What was my previous profit? It is given in the question. No, it is not given in the question. So they are asking me consequences of profit and break-even point. So if they ask me consequences of profit, I'll have to find out also existing profit. What will be my existing profit? I'll have to find it out. If there is a change in sales ratio to 2:3. Existing 30,000, 20,000 units multiplied by 10 multiplied by 50. This will be 3 lakhs. This will be 3 lakhs minus 2 lakhs minus 3 lakhs. This will be 1 lakh. This will be 0. So what is my existing profit is rupees 1 lakh. If you change the sales mix ratio, what is existing sales ratio? 3:2. If you change your sales mix to 2:3, sir, total demand is 50,000. Are this product interchangeable? Yes. They both are manufacturing same product. Their cost criteria is different. So if the total demand is 50,000, instead of taking 30,000 from X and 20,000 from Y, it is advisable to take 20,000 from X, manufacture 20,000 in X and manufacture 30,000 in Y, because it will give you higher profit, which is 1,50,000. Will be giving me higher profit, 1,50,000, 50,000 more. So sales ratio should be changed to 2:3, but they are telling me effect on profit and effect on even break-even point. So what was the break-even point if my sales mix was 3:2? Break-even point was this. What will be break-even point if my sales mix is 2:3? If my sales mix is 2:3, you will again have to find out break-even point. Total fixed cost 5 lakhs rupees. Contribution per box, where box contains 2 of X plus 3 of Y. So box will be giving me 2 into 10 plus 3 into 15. This will be 45 plus 20, 65 rupees per box. What will be break-even point in boxes term? Fixed cost divided by contribution per boxes. Fixed cost is 5 lakhs divided by contribution per box is 65. Five lakhs divided by 65. 7692 boxes. 7692 boxes. Will be my break even point in boxes. How many of X and Y? 7692 boxes. X is multiplied by 2 and Y is multiplied by 3. This will be this many X units and this will be Y units will be break even point. 7692 multiplied by 2. 15,384. Units of X and 7692 multiplied by 23076. This will be my break even point if the sales mix is changed from 3:2 to 2:3. What was my break even point if it was 3:2? 25,000 of X and 16,667 for Y, and here it is 15,000 for X and 23,076 units for Y. So if the sales mix is 3:2, all the data we have found out. If the sales mix is 2:3, all the data we have found out. They are not telling me to give suggestions, so I am not giving. I will be telling consequences of profit. Profit will increase if you change your sales mix ratio from 3:2 to 2:3. This was C14.15. Next one. This is also an excellent question of break even point. 14.16. Omega Limited manufactures a product currently utilizing 75% capacity with a turnover of 99 lakhs. So their turnover is 99 lakhs and they are at 75% capacity. Let me find out here itself. If they were working at 100% capacity, what would have been their turnover? So it is 99 lakhs divided by 75%. Their turnover would be 132 lakhs. You can verify 132 into 75% will be 99 lakhs. So you are right now working at 99 lakhs capacity, rupees capacity. Your total capacity is rupees 132 lakhs. At rupees 275 per unit, how many units you might be selling? 99 lakhs divided by 275, that is 36,000 units. You can write it down in answer itself. 36,000 units is present sales at 75% capacity. All right. The cost data is as under: direct material per unit 96, direct wages per unit 42, and variable overhead per unit is 18. So those are all variable costs, right? Direct material, direct labor is always variable cost, and variable overhead is 18. So variable cost is equal to 96 plus 42 plus 80. 156. Semi-variable overhead. What is semi-variable overhead? It will be having a fixed portion. It will be having a variable portion also. So there will be variable cost of semi-variable overhead also. From this 7,32,000. They are not fixed, not variable, means a portion of that is fixed and a portion of that is variable. PV ratio is 40%. This will be total variable cost, right? Now, PV ratio is 40%. Try to understand what is selling price per unit. 275. What is the PV ratio? 40%. So what will be contribution per unit? 275 into 40%, which is 110 rupees. So what will be variable cost per unit? Will be 275 minus 110 or 275 multiplied by 60%. 165. If total variable cost is 165 per unit, here we have got answer only of 156. Total variable cost is 165. So how much of this portion will be variable? It is 165 minus 156. It is 9 rupees. So, see in semi-variable cost, I am writing down something. 9 rupees per unit is variable. Let me write down a working note for semi-variable cost. Semi-variable cost is 7,32,000. Out of which I have found out that variable is 9 per unit. How many units right now I am selling? 36,000 units. So 36,000 into 9 is variable. 3,24,000. So if 7,32,000 is a mixture of fixed and variable cost, and 3,24,000 is a variable portion of it, then fixed portion will be 7,32,000 minus 3,24,000. 4,08,000. And fixed overhead cost is 28,81,000. Sir, this is included in this? No. 7,30,000, 32,000 is a mixed fixed plus variable cost. And there is other fixed cost of 28,81,000. Fixed cost is 28,81,000 up to 80% level of activity. Right now, let us concentrate only on 80% level of activity. So our fixed cost will be 28,81,000. Up to 80% activity. Other fixed costs are 28,81,000. Let me summarize by all the answers that I have found out. Selling price per unit is 275. Variable cost per unit is 156. No. Plus 9, 165. And my fixed cost will be 4,08,000 plus 28,80,000. This both are fixed cost. What is 4,08,000? Fixed portion of that semi-variable cost. And what is 28,81,000? They are pure fixed cost. So 28,81,000 plus 4,08,000. It is 32,89,000. $32,89,000 will be my fixed cost, and this is the information. Instead of giving directly this information, they have given information in a weird manner so that it becomes somewhat challenging. they have given variable cost, some variable cost which were 156, and then they have given a new concept which is semi-variable cost. So a portion of that semi-variable cost is variable and a portion of that semi-variable cost is fixed. How we found out? We were having PV ratio, so we got total variable cost per unit. If total variable cost per unit is available, this 9 rupees can be found out, which is a portion of that semi-variable cost. And then we found out from that semi-variable cost, what was the portion of fixed cost. So this up till this the information is available. And yes, right now currently I am selling 36,000 units, which is at 75% capacity. Break even point in units and activity level at break even point. Let me first find out break even point in units. Break even point in units will be fixed cost upon contribution per unit. Fixed cost will be 32,89,000 divided by contribution per unit will be 275 minus 165, or we are having it right now here 110. $32,89,000 divided by 110, which is 29,900. $29,900 units is break even point at for the company right now. And they are also telling us to find out and activity level at break even point. So 36,000 units was a 75% capacity, right? 36,000 was 100% capacity. 36,000 units was 100% capacity. Then 29,900 units is how much percentage capacity? 29,900 multiplied by 100 divided by 36,000. It is 83.05% capacity. Yes? Okay, 36,000 is at 75% capacity, right? So what will be at 100% capacity? That will be 100% capacity. We need to find it out. Or you can do directly this. This is at 75% of capacity. So 29,900 units will be at what capacity? I will be getting capacity of 29,900, which will be 29,900 multiplied by 75 divided by 100. It is 29,900 multiplied by 75 divided by 36,000, which is 62.29. 62.29%. So out of 100% capacity, the company is working only at 62.29% capacity to break even. So if the company will be say working at 70% capacity, it will be earning profits. If the company will be having 40% or working at 40% capacity, it will be incurring losses. Now, this is good that this answer is less than 80%. Why? If the answer was more than 80%, beyond this level, up to 80% activity, the fixed cost is 28,81,000, which we have considered. But beyond this level, an addition of 2,38,500 will be incurred, which we have considered or not considered? We have not considered. In this case, we need to consider it? No, because our activity level is not going beyond 80%. So this is break-even point in units. Level at break-even point we have found out. Second number of units to be sold to earn profit of 25 per unit. Number of units to earn profit of rupees 25 per 14.17. A manufacturing company is producing a product A which is sold in the market at 45 per unit. The company has the capacity to produce 40,000 units per year. The budget for coming year project a sale of 30,000 units. The cost of each unit are expected as under: material 12, wages 9, overhead 6. So total variable cost will be 12 plus 9, 21 plus 6, 27. Margin of safety is 4,12,000. Calculate fixed cost and break even point. So what is available? Try to concentrate. Selling price is available 45. Variable cost is available 27. So 18 will be contribution per unit. Margin of safety is available. Margin of safety is 4,12,500. What I can find out is easily profit, right? If I get profit, I will be getting fixed cost because number of units are available. How to find out profit? Margin of safety in rupees multiplied by PV ratio will be is equal to profit. Margin of safety in rupees is 4,12,500. PV ratio I can easily find out: 18 divided by 45 multiplied by 100. 40%. So 40% of 4,12,500, we know, right? Break even point into PV ratio is nothing but fixed cost. Margin of safety multiplied by PV ratio will be nothing but profit, and total sales multiplied by PV ratio will nothing but be contribution. So 4,12,500 into 40%. 1,65,000 is profit. So if your total contribution is 30,000 into 80, contribution is 30,000 units into 80. Five lakh 40,000. And if your profit is 1,65,000, you can easily find out your fixed cost. Remaining will be your fixed cost. 5,40,000 minus 1,65,000, 3,75,000. So my fixed cost is 3,70,000. If you are having fixed cost, break even, PV ratio, you can find out anything. Calculate fixed cost. Calculate break even point. I can find it out in rupees also. I can find it out in units also. Break even point in units will be is equal to fixed cost upon contribution per, which will be is equal to 3,75,000 divided by 80. 3,75,000 divided by 80. 20,833 break even point in rupees will be is equal to 20,833 multiplied by selling price. Selling price is 45. $20,833 multiplied by 45. 937,485. Break even point in units and rupees are very easy. Third. Second, calculate the volume of sales to earn a profit of 20% on sales. Calculate the volume of the sales. So, I always do this. If my sales units is X, what will be my contribution minus fixed cost will be is equal to profit? What will be my total sales will be is equal to, what is my selling price per unit? 45. So total sales will be 45x. What will be contribution? What is contribution per unit is 18. So my contribution will be 18x. My fixed cost is 3,75,000. And I want the profit of 20% on sales. What is my sales of 45x? So what profit I want? 45x into 20% will be 9x. So I want 9 rupees per unit as profit, or I want a total profit of 9x. How I found out? 45x will be my total sales multiplied by 20% is nothing but profit on sales. I want 9x. So 3,75,000 divided by 9 will be 41,667. X should be 41,667 units to be sold to earn profit of 20% on sales. Third one, if the management is willing to invest 10 lakhs with an expected return of 20%, calculate unit to be sold to earn this profit. And now you have learned finance, it is very easy. What management is investing in the project? 10 lakhs. What is the expected rate of return? 20%. So they want 2 lakhs rupees as profit. Because they have invested some money, they want a profit of 2 lakhs. They don't want zero loss and zero profit, zero loss. They want a 20% return on that 10 lakhs rupees investment, means they want a 2 lakhs rupees profit. So a simple formula for desired profit, and I'll solve the answer. Sales for a desired profit in units, fixed cost plus desired profit upon contribution per. My fixed cost is 3,75,000 plus desired profit is 2 lakhs upon contribution per unit is 80. This is 5,75,000 divided by 80. 31,944. This much unit should be sold to earn 2 lakh rupees. Easy one. Fourth, management expects additional sales if selling price is reduced to 44. Calculate unit to be sold to achieve the profit as desired in C above. So they are changing selling price per unit. selling price is reduced to 44. What is current selling price? 45. If a selling price is 44, variable cost does not change if you change your selling price. So variable cost remains at 27 and your contribution per unit will be, instead of 18, it will be 70 rupees per. You want the same amount of profit? So sales for desired profit in units will be fixed cost plus desired profit upon contribution per unit. It will be same as over here. 3,75,000. You want same profit of 2 lakhs, but now your contribution per unit is 17. So you will have to sell some more units. 5,75,000 divided by 70. 33,824. To be sold if you reduce the selling price and you want to earn profit of rupees. Very simple and easy question. 14.17. And I feel this is one of the finest question drafted in marginal costing. 14.18. The comparative profit statement of 2 quarters of a firm is as under. Unit sold 2,500, 3,750. Direct material is given, direct wages is given. Now try to understand, in quarter 1, if you are selling 2,500 units and your material cost is 87,500, you can easily find out material cost per unit. Variable cost per unit will remain same. Let me find it out. What will be cost per unit? Will be 87,500 divided by 2,500. Will be 35. So it is material cost. 35. So I can easily find out for quarter 2. Let me find out in question itself. 3750 into 35, which is 131,250. You need to write it down in answer. You cannot write it down in question. But here I am having space, so I am just writing it down. So per unit direct material is this, and this question mark I have filled up. Similarly, I can fill up direct wages also. 62,500 divided by 2,500. 62,500 divided by 2,000, which is 25. So direct wages is 25 per unit. So in quarter 2, it will be 3750 into 25. $93,750. Now this is where the question is very nice. Fixed and variable factory overhead. So this is semi-variable. It is neither fixed nor variable, or a portion of which is fixed and portion of which is variable. To segregate this, we can easily segregate it. Try to understand. Is this total? Yes. What is total? 75,000 total cost. That is fixed plus variable. 75,000 and 95,000. Units are available? Yes. 2,500, 3,750. If total cost is available, total units is available, we can easily find out the answer. How? Difference in cost divided by difference in units is variable cost per unit. It is not fixed cost per unit. It is variable cost per unit. So this is how we will be finding it out. But this does not end over here. Let us first read the question. Sales is 2,75,000. I can find out even selling price per unit, right? What will be selling price per unit in this 2,75,000 divided by 2,500? 2,75,000 divided by 2,500, which is 110. And here sales will be 3,750 into 110. So it will be 4,12,500. Will be my sales in quarter 2. Profit is given for both the cases 50,000 and 66,250. All right. In the second quarter, the direct material price has increased by 20%. What does this mean? This is not correct. Because in quarter 2, material price per unit will not remain 35, it will increase. There was a savings of 5,000 rupees in fixed overhead in the second quarter. There was a 5,000 fixed overhead in second quarter which has been saved. So here it would have been 1 lakh rupees fixed cost, but some 5,000 rupees has been changed. The other cost and selling price remain same. Determine the quantity that should have been sold in second quarter to maintain the same amount of profit per unit to maintain same amount of profit per unit as in first quarter. I will be preparing full-fledged chart of first quarter per unit also, quarter 1 also, and then I will be doing proposed of quarter 2. So quarter 1, I have found out many of the answers per unit rupees. Quarter 2 per unit rupees. Unit sold 2,500, 3,750. $2,500 units, 3,750 units in quarter 2. Let me not write it down over here. Direct material, $35, and the total is 87,500. What will be direct material in quarter 2? The direct material price has increased by 20%. So 35 has increased by 20%. So per unit will be 35 plus 20%, that is 42 per unit. So my material cost will be 3,750 into 42. 157,500. What will be direct wages? $25,000, 62,500. The direct wages is not changing. So it will remain 93,750. 93,750 and per unit will remain same, which is 20. Fixed and variable overhead, this is where everything matters. Try to understand. In that semi-variable overhead, there will be portion of variable overhead. And there will be portion of fixed overhead.
There will be portion of variable, there will be portion of fixed. But they have not given us whether it is fixed or variable. They have directly given us total 75,000 and 95,000. Please try to concentrate. I will be using this chart, but still I cannot use this chart directly. Concentrate. If the fixed cost is the same in this book, then only I can use that formula, change in total cost divided by change in units will be is equal to variable cost per unit. This formula I can use if variable cost per unit is same and fixed cost in total is the same. Here there is one problem. What is the problem is this? There was a savings of 5,000 in fixed overhead. In quarter 2, your fixed cost was 5,000 rupees less. Now sir, then how to solve it? Because the basic assumption is gone. Try to understand. Let us assume that there was no change in fixed cost. The savings of 5,000 in fixed cost doesn't happen. Then what would have been our fixed cost? Would be 95,000 plus 5,000 is equal to 1 lakh rupees. Sir, but there is a saving in fixed cost. Agreed. But that savings in fixed cost, if we consider, we cannot take this formula. We will not be finding out variable cost per unit, because to use this formula, variable cost per unit should be same and total fixed cost should be same. Here fixed cost is changing. So what I am doing, I am first equalizing that fixed cost. That suppose the fixed cost was rupees 1 lakh. Now that savings is not there. So what was fixed cost before? Total cost before 75,000. What is total cost now? 1 lakh. Actually total cost is 95,000. But the fixed cost savings I am ignoring and adding it back, and it is 1 lakh. Now I can use this formula. Change in total cost is 25,000 and the change in total units is 1,250. So my variable cost per unit as far as the semi-variables are concerned, my variable cost per unit will be 25,000 divided by 1250, which is 20 rupees. 20 rupees is variable cost per. So in this quarter 1, quarter 2, variable cost will be 2,500 into 20. That is 50,000. It is 50,000. So what will be fixed cost in quarter 1? 75,000 minus 50,000 will be 25,000. Sir, what would be variable cost in quarter 2? 3750 into 20. Which will be 3750 into 20 is 75,000. What is total cost? 1 lakh. So what is the fixed cost? 25,000. See, fixed cost is remaining same. Yes. But sir, total cost is not 1 lakh in quarter 2. Actually, it is 95,000. Because there is a savings in fixed cost. This is not 25,000 but only 20,000. So your total cost will be 75,000 and your total cost will be 90. Sir, now you have reduced your 5,000. I have added that 5,000 to find out this 20 rupees variable cost per unit. Had I not added that 5,000, I can never use this formula to find out variable cost per unit, because fixed cost in total should remain same, right? So what I did, total cost, I was coming same, 25,000, 25,000, and then I reduced again 5,000 to find out my correct answer. Now I am having all the answers. Variable cost
is 20. Variable cost portion is 20. So it is 2,500 into 20 is 50,000. And fixed cost is 25,000. Fixed cost per unit is never important. So let me not write it down. Here also this remains 20. This is 75,000. But fixed cost instead of 25,000 is reduced by 5,000 and so it is 20,000. Excellent point. The other cost and selling price remain same. Determine the quantity that should be sold in second quarter to maintain the same amount of profit per unit as in first quarter. All right. So what is the profit I will be earning? This will be my total cost. 87,500 plus 62,500 plus 50,000 plus 25,000. 2,25,000. Sales will be 2,500 into it is directly given 2,75,000. My profit is 50,000 total. Per unit will be 50,000 divided by 2,500, which is 20 rupees. Per unit will be profit. In quarter 2, what is my total cost? No, I will not have to find out total cost. Why? I am selling 3750 units. Now they are telling me how many units I should sell to earn a profit of 20 rupees per unit. Right? So I am not selling now 3750. So my variable cost will not be this. But yes, variable cost per unit will remain this. 7. This is 8. 87 is variable cost per unit. I am also having fixed cost, which is 20,000. I can easily find out a desired profit in that equation format. If units sold are X, how much contribution I will be getting? Selling price I am not changing. What is my selling price? It is 110. 110 is my selling price and 87 is my cost. So 110 minus 87 X will be my contribution minus 20,000 fixed cost should be my profit, and profit should be 20 rupees per unit. So it should be 20x. This is the 23x. So x will be is equal to yes. I'm just repeating the equation. You want a profit of rupees 20 per unit. So I cannot take this all cost because this cost is a variable cost at 3750 units. So how many units I will be selling so that I will be getting profit of 20 rupees per unit? What they want is same amount of profit per unit as in first quarter. In first quarter, what was my profit per unit? 20 rupees per unit. How I found out? Total profit. It is sales minus total cost divided by number of units. So 50,000 divided by 2,500, which was 20. So 20 rupees per unit is my quarter 1 profit. My quarter 2 profit should be also 20 rupees per unit. How much should be unit sold? Say unit sold is X. What is my selling price? 110. How I have found out? 2,75,000 divided by 2,500 is 110. Now selling price is not changing as compared to quarter one. So selling price is 110. What is variable cost? Variable cost is 87. We have found out how. 42 material, 25 labor, and 20 rupees semi-variable variable portion. So it is 87. What will be contribution? Will be 23. Can I say total contribution minus fixed cost should be is equal to profit? What will be total contribution if I am selling X units at 23? Contribution will be 23X minus what is my fixed cost? Fixed cost is 20,000. Should my profit be 0? No, then it will be break even. My profit should be same amount per unit as I was earning in quarter one. What profit per unit I was earning in quarter one? 20. So I want 20 per unit sold. So 20x. This will be 3x is equal to 20,000. X will be 6,667 units. If you sell 6,667 units, you will be earning 20 rupees profit per unit. This is nothing but for desired profit. Let me even prove it. This is not required in examination. This just I am proving it. Concentrate. If you sell 6,667 units, how much will be your contribution multiplied by 23? So I am not doing sales minus variable cost because then it will be easy. It will be 6,667 multiplied by 23, which is 153, 341 will be my contribution minus fixed cost of 20,000. So what profit I would be earning? 133, 341. If 133, 341 is my is my profit. What is profit per unit? Will be 133, 341 divided by 6667. 133, 341 divided by 1667. So it was just a calculation error, right? 133, 341 divided by 6667. It is 20. 20 rupees per unit will be nothing but my. Let us solve some question of marginal costing. C 14.19. The MTech manufacturing company is presently evaluating two possible processes for the manufacture of a toy. The following information is available. So by both the processes, you are going to manufacture that same toy. Process A and process B. Variable cost per unit in process A is lower. Selling price for both is same because ultimately both the processes are manufacturing same toy. Total fixed cost, wherever the variable cost is lower, the fixed cost should be higher. Otherwise, always if variable cost is also lower and fixed cost is also lower, that process will always be preferable. Capacity, that is total capacity is given, and anticipated sales is 4 lakh units. See what I will be doing. I will be finding out indifference point, which is nothing but a change in fixed cost divided by change in contribution per. What is difference in fixed cost? 30 lakhs minus 22 lakhs is 9 lakhs rupees. Divided by difference in contribution per unit. What will be contribution for process A? Will be 20 minus 12 is equal to rupees 8. And process B will be 20 minus 14 will be is equal to rupees 6. Difference is the 2 rupees. divided by 4,50,000 units is indifference point. How to analyze indifference point? If this is number line of units, indifference point is the 4,50,000 units. If your anticipated sales is greater than 4,80,000 units, you should select the option with higher fixed cost, lower variable cost. And if it is below 4,50,000 units, it should be, you should select lower fixed cost, higher variable cost. Right now, the anticipated sales is 4 lakh units. You should select lower fixed cost, higher variable cost, which is nothing but process B. Under current circumstances, process B will be preferred. Would you change your answer as given above if you were informed that the total capacity, now total capacity is not important, of two processes are 6 lakhs and 5 lakhs unit? They are not important because your anticipated demand is 4 lakhs rupees. Both the processes are able to meet your demand. So whether the capacity increases, that does not make any difference. When the capacities are written, we are not assuming it as demand, we are assuming it as a manufacturing capacity. This is 14.19. We are going to 14.20. PH Gems Limited is a manufacturing ready-made shoots. It has annual production capacity of 2000 pieces. The cost accountant has presented following information for the year to the management. Sales 1500 pieces at the rate of 1800 per piece. So one shoot is sold at 1800 per piece, and this is my total sales. Direct material, direct labor and overhead, out of which 40% fixed is given. That is 11,97,000. Evaluate the following options. If the selling price is increased by 200, the sales will come down to 60% of the total annual capacity. Now what is annual capacity is 2000. So the sales will be reduced to 1200 pieces. Should the company increase its selling price? So we know the current profit, right? Let us find out if selling price is increased by rupees 200. What will be my sales then? My sales will be 1200 pieces multiplied by 1800 plus 200. That is 2000 rupees per piece. This will be 24 lakhs rupees minus variable cost. Direct material. This direct material is for 1500 pieces. Now the direct material will be reduced for 1200 pieces. I am not finding out per unit, but you can just cross multiply it. If for 1500 pieces it is 5,94,200 and they are variable cost, it is dependent upon number of units produced and sold. So for 1200 units it is how much? So 594,200 into 1200 divided by 1500 will be my material. 47,536. Labor, also same thing. 4,42,600, 4,42,600 multiplied by 1200 divided by 1500, which is 3,54,080 rupees. After labor, overhead, there is variable, there is fixed. Fixed overhead is going to remain same. What is fixed overhead? 11,97,000 into 40% is fixed. So 478,800. 478,800 is going to remain fixed. How much will be variable? Variable will be 11,97,000 into 60%. Into 60%. This is if 1500 pieces are manufactured. Now I am manufacturing only 1200 pieces. So 1200 divided by 1500. 5,74,560. 5,74,560 will be my variable cost. I will be getting anticipated profit if the selling price has increased by 200 rupees, which will be 24 lakhs minus 47,536 minus 3,54,080 minus 574,560 minus 478,800. 9,45,024. Making some mistake? Yes, material is this is 594,200. So it cannot be 47,536. 594,200 multiplied by 12 divided by 15. 475,360. 10 is. So let me calculate it again. 24 lakhs minus 475,360 minus 354,080 minus 574,560 minus 478,800. This is 5,17,200. So proposed profit is higher. This is higher than rupees 4,66,200, and hence we should implement this proposal. Number 2, the company can earn a profit of 20% of sales if the company provides typing with ready-made shoots. The cost of each typing is rupees 80. Calculate the sales to earn a profit of 20% on sales. So this question can be solved in two manners. We need to find out sales to earn a profit of 20% on sales. So first we will not be considering this first point. Either we will have to sell more number of units to cover this cost, or I will have to increase the selling price. Sir, what assumption should we take? You can take any assumption. I am taking that we will be increasing the selling price by selling 1500 pieces and not just 1200 pieces. So let our sales units be 1500 units at a selling price of X rupees per. So we will have to increase our selling price. Now the selling price cannot be 1800 per piece. So you will have to increase your sales can increase, either you increase the quantity or you increase the selling price. I have taken what selling price I should increase, or how much should be the selling price to earn a profit of 20% on sales. So what will be my sales then? 1500 x minus, what is my variable cost? Let me find out variable cost per unit right now. Variable cost was let me first segregate variable cost from this. 11,97,000 multiplied by 0.6. 7,18,200. 7,18,200. So this plus this plus this is variable cost. 5,94,200 plus 4,42,600 plus 7,18,000, 17,55,000. 17,55,000 5,000 divided by number of units is 1500 pieces. This is my variable cost, or the variable cost is going to remain same because I am manufacturing 1500 units only. So 17,55,000 will be my variable cost. Minus my fixed cost. Fixed cost is nothing but 4,78,800. And this profit is given, it should be 20% on sales. So it should be 0.20 1500x. So it will be 300x. 1500x minus total of this is 17,55,000 plus 478,800, which is 22,33,800 minus this is 300x is equal to 0. So x will be is equal to 22,33,800 divided by 12, which is 1861.5 rupees should be selling price per piece. What we have done a mistake, we have not taken that cost of the pin. Tie pin is costing rupees 80. So we should consider that cost in variable cost. Minus 1500 into 18 will be additional cost. 1500 pieces into 18 rupees, that is 27,000 rupees more. Minus additional variable cost is 1500 into 27,000, negative 27,000. This will be minus 27,000 more over here. Answer will be 22,33,800 plus 27,000 divided by 1884. This answer will be 1884 rupees should be selling price per piece, so that you can earn 20% profit on your sales, and this will be this particular answer of answer number 2. This is 14.20. Next question is C 14.21, and we will be learning concept of limiting factor. The Proof of Value Limited manufactures 3 products X, Y and Z that uses the same machine. The budgeted profit and loss statement for the 3 products are as under. Sales is given, prime cost is given, variable cost overhead is given, and fixed overhead is given. So there will be contribution over here. Annual sales and demand is 5,000 units, 7,500 units and 2,500 units. Machine hour per unit. So 20 hours can manufacture 1 unit of X. 21 hours can manufacture 1 unit of Y, and 26 hours can manufacture 1 unit of Z. However, after the budget has been formulated, an unforeseen condition has meant that during the next period, the available machine capacity has been limited to 2,96,500. What is the shortfall in the available machine hours for the next period? All right. So we understand contribution, right? X, Y and Z. Sales minus variable cost or profit plus fixed cost will be nothing but contribution. So what is contribution of X is 2,50,000 rupees. Or 10 lakh minus 5 lakh minus 2,50,000 is nothing but contribution of X. Contribution of Y will be 3,75,000 rupees. And Z will be 1,25,000. What are units under consideration? X is 5,000 7,500 units and 2,500 units. Fixed cost is irrelevant for this type of decision making. Alright. So all three products are having positive contribution. So practically we should manufacture all the production units. But how many total hours will be required to manufacture X? Manufacturing hours total 5,000 units into 20 hours per unit. This is 1 lakh hours. 7,500 units into 21. 157,500 hours, and this will be 2,500 units into 26. 65,000 hours. So what are total hours required is 1 lakh plus 1,57,500 plus 65,000 hours, which is 3,22,500 hours. But you are having only 296,500 hours. You are having only 296,500 hours are available. So you will not be able to manufacture all the products and satisfy demand for all the products, because you are having short of 322,500 minus 296,500, which is 26,000 hours. Will be my short. Now the thing is, if there is a shortfall in number of hours, you will have to compromise manufacturing of either X, Y or Z. So how you should give the priority to X, Y and Z? That is important. We know answer of contribution. We can also find out answer of contribution per unit, which will be rupees 50 over here. It is 3,75,000 3,75,000 divided by 7,500, which is 50. And this will be also rupees 50. But to earn 50 rupees contribution, here 20 hours is required. For 50 rupees contribution, here 21 hours is required, and for 50 rupees contribution, here 26 hours is required. So if your limiting factor is number of hours, you should manufacture X first. Sir, how we should give ranking? Very easy point. You should find out contribution per hour. 2,50,000 divided by 1 lakh will be 2.5 rupees per hour. 3,75,000 divided by 157,500. 2.38 per hour. 1,25,000 divided by 65,000. 1.9. See, what is my objective now is not to earn maximum contribution, because I can earn maximum contribution of total of this much. But now there is a limiting factor of number of hours. So my objective is to maximize contribution per hour. And so this is contribution per hour. If I am going to give the rank, this will be first, this will be second, this will be third. In next question, the question says, the accountant has ranked the product in the preference, that is all right. Calculate the number of each unit that should be manufactured for next period. So we should manufacture this 5000 units. Our total answer will be manufacturing of 5000 units. So how many hours it will consume? 1 lakh hours. We are having 296,500 hours. Another, we can manufacture this 7,500 units also. It is having rank 2. And I will be having 1,57,500 hours. So how many hours I have utilized? 2,57,500, and I am having 296,500. So I am having only additional 39,000 hours. For product Z, it takes 26 hours to manufacture one unit. So I will be manufacturing 39,000 divided by 26, which is 1500 units only. Of product Z, it is having third rank. The total capacity is 2,500. See, we can sell 2,500. We should sell it if we are having another machine hours. But we are not having enough machine hours, so I'll be selling only manufacturing and selling. Product Z is concerned 1500 units. This was again a good question. Next is C14.22. LR Limited is considering two alternative methods to manufacture a new product. It intends to market. The two methods have a maximum output of 50,000 units each and produces identical items with a selling price of rupees 25 each. The costs are variable cost per unit is given. Selling price under both the cases will be same because the processes are different but the product is same. I can easily find out contribution under both the methods. Contribution per unit 25 minus 15 will be rupees 10. And here 25 minus 10 will be rupees 15. Fixed cost is given is 1 lakh rupees, 3 lakhs rupees. I can find out the difference. Difference in contribution per unit is 5. Difference in fixed cost is, I can easily find out cost in difference point. Indifference point is equal to difference in fixed cost divided by difference in contribution per unit, which is the 2 lakh rupees divided by 5 per unit, which is 40,000. We need to also find out a break-even point for each method. So for this method number 1, break-even point in units will be is equal to fixed cost 1 lakh divided by contribution per unit, which is 10. So it is 10,000 units. 2 will be 3 lakhs divided by 15 will be 20,000 units. What is indifference point? 40,000 units. So if I draw a chart, logically my units number line will look like this. 10,000 units. This is method number 1. 20,000 units. Method number 2. And 40,000 units in difference. Below this, higher fixed cost, lower fixed cost, higher variable cost should be preferred. Greater than indifference point, higher fixed cost, lower variable cost. Which is higher fixed cost? Higher fixed cost is method number 2. Should be preferred if my expected sales is greater than 40,000 units. Below that, method number 1 should be preferred. So under all these cases, method number 1 should be preferred. Below this, you will be having loss even in method number 1. And in this, you will be having loss in method number 2. This is understanding of indifference point as well as break-even point.